Welcome and thank you for joining today's Market Surveillance Committee meeting. Before we begin, please ensure you have opened the participant and chat panel by using the associated icons on the bottom right corner of your WebEx screen. Please note that all audio connections are in listen-only mode. Please note that we will not be taking chat questions during this event and that all questions and answers will be done verbally. To indicate you wish to ask a question verbally, click the raise hand icon located on the bottom right of the participant panel box. If you are not logged into WebEx, dialing *3 will place you in the question queue. You will hear a beep tone when you're unmuted. At that time, please state your name, organization, and question. If you require technical assistance, please send a chat to the host. With that, I'll turn the conference over to Dr. Ben Hobbs, Chair of the Market Surveillance Committee. Please go ahead.
Thank you very much, Ryan, and thank you to all the audience for joining us today. I'm Ben Hobbs. As Ryan said, I'm chair of the MSC, and with me are Doctors Jim Bushnell and Scott Harvey, who are also members of the Market Surveillance Committee. We also have with us on WebEx members of the ISO staff, including Amelia Blank, Shami Davis, Guillermo Bautista, Quinn Zhao, Becky Robinson, Scott Lehman, Danny Johnson, and Anna McKenna, all of whom will be either presenting or helping in terms of the discussion and answering questions this afternoon. Let's see. Before we get into the main agenda items, which are the market power mitigation metrics and EDAM congestion rent allocation, as always, we have an open comment period. Please feel free to ask questions or make comments on any issue concerning the ISO markets. Although if there are questions about the market power mitigation metrics and congestion rent allocation, I ask you to hold those questions until we get to those items on the agenda. So, as said, don't put questions in the chat, please. We'll wind up overlooking those unintentionally, but rather please queue up following Ryan's directions. Ryan, you want to check if anybody is queued up on the phone lines?
Yep, so we do have already one hand raised from Don Trethewey. Would you like to take that call?
Of course. Don, welcome.
All right, Don, you're unmuted.
Morning, Ben. Don Trethewey from the California Energy Storage Alliance. So last year, the CAISO identified that the flexible ramping product was being awarded to storage resources that were not deliverable because they had insufficient state of charge. I think it's a similar issue we've dealt with FRP since the beginning, where the market optimization continues to outsmart everybody and identifying and awarding FRP to resources that can't be dispatched for energy because they have a zero marginal energy cost, or excuse me, a zero opportunity cost.
Right.
And so the CAISO published a red line to their BPM to address just the flexible ramping up product by including it in the state of charge calculation that includes regulation up and regulation down to try to address this issue. And I think we would really appreciate the MSC looking into, the appropriate way to consider the state of charge of these, the flexible ramping product, the regulation products, and to understand what the impacts of that mean to the, the opportunity cost calculations by considering them. So I know you have a media agenda today. I just think it would be a very good topic to discuss at the next MSC meeting, particularly given that imbalance reserves, the envelope equations also have the impact of imbalance reserves on storage resources state of charge, and the previous issues we had with including, for instance, the regulation products in the state of charge, where regulation down prices ended up being negative until there were some additional modifications to the constraints. So it's just a request for something to look into further at a subsequent MSC meeting. Thanks.
Okay. Thanks, Don, for seeing the connection between the FRP's problems with procuring FRP from resources with zero opportunity cost because they're located behind a transmission constraint, and the connection of that, the similarity of that to having a lower zero opportunity cost because there's no state of charge to support the dispatch. And so as you say, the smart optimization would definitely prefer resources with zero opportunity cost, and that results in this situation. So so we've had previous meetings and an opinion about the envelope calculations, at least in general, the idea of trying to match sort of an expected discharge of state of charge, because when you're scheduled for regulation up or you're scheduled for FRP up, over time, if you're not just procured but you're deployed, there will be some loss of charge. The guess is that there's a lot of uncertainty around that expected value, and the market software is not a stochastic program, so there are always going to be circumstances where you're still caught short, unless you are so conservative that you wind up you're losing value because you're not making the resource available for other purposes. If you have really conservative values in the envelope question, there's no in the envelope equation, there's really not a very good solution to that. Although having zero is probably not is of course not the right value. So these are, because these are deterministic approximations, they're going to have to be tuned, and experience is going to have to tell you what sort of levels are sufficiently conservative but don't cost you too much. And perhaps in the long run, they're going to have to be more explicitly stochastic approaches. So we have talked about that before, Don, and I'm wondering if you're interested in seeing data on experience, or maybe looking at other approaches than what the ISO has wound up proposing. So I'm sorry, Don, if I'm not letting you go, and maybe you can just tell us a little bit more of what it is you'd like to explore further in the envelope expressions.
Yeah, I see Guillermo's on, and I know that they do have the configurable parameters where they're looking at doing some analysis on that prior to go live. I think would be interesting. I think the question that I always have is, you're right. Do you put zero in, or do you put 100% in terms of the impact? And when I think of FRP, when it was originally designed, the intent was, if you were not dispatched for energy because we needed your ramp capability, that you would earn the same profit as if you were scheduled for energy or scheduled for FRU, for example. So if I had earned a $10 profit for providing FRU or for providing energy dispatch, my price for FRU would be $10, and we've never reached that goal. But if you put in the assumption for the state of charge change, what does that do? If you put it in at zero, how does that impact that logic? Do I get the same price whether I was scheduled for FRU or scheduled to be discharged? And I think that's sort of the discussion that I would like to see. What is the actual opportunity cost? Because ideally, you'd want to see the same profit as if I was discharged for FRP or discharged for energy or held for FRU, because that provides the incentive to always follow the CAISO dispatch. But I don't know if that's the case if you do some of these assumptions that the SOC isn't impacted, or is fully impacted, or not fully impacted.
And all of this is much more complicated because, say you're reserving state of charge to support FRP schedules later, they may be a number of intervals in the future, and the amount of the loss of SOC that has to be made up for, and is itself an opportunity cost, is it would be uncertain if you don't know what interval in the future you might actually be deployed. So
Yeah.
I
mean,
think
a
I
good
understand. I
example
think I understand what you're saying.
Yeah. Another good example is the issue that was observed when they created the attenuation factor SOC in the first place, when they added regulation up and regulation down. And that's where they observed regulation down prices going negative. And that's because the market optimization was saying, look at this, I can charge the battery for free and by simply awarding it regulation down.
Right. And
That's why we
I
went to
think
the
that hopefully was corrected. Go ahead, Scott.
I think that's why we went to the envelope. But I think there's a deeper problem, Don, which is that this fix only addresses the situation when we get to the net load peak hours and it sees that we need the storage and that there isn't enough. I think the real problem is 4, 5, 6 hours earlier when we're scheduling 13,000 megawatts of storage to provide all the FlexiRamp, and we're not committing any units because Stuck and FMM don't see a problem because it's too far in the future. And it isn't just managing it when we get to the hours of, we've run out of state of charge or we're really low. I mean, it goes further back in time to make sure that that we don't schedule or that we commit other units to provide the FRP during those hours so that we don't deplete the storage.
No, I don't disagree with that either, Scott, in terms of the need for potentially a longer outlook for the FRP product. I completely agree with that.
Okay. So that's teed up, noted, and we'll talk about perhaps having a session on that in an MSC meeting sooner or later. I'm not sure when the ideal time would be, but we'll discuss that with staff, Don. And we appreciate that the ongoing issues with FRP are really important to the ISO, and as the interactions with other products and with storage become more and more important, it's just simply going to become more difficult. Okay, Don, thank you. Ryan, is there anybody else queued up?
Yep. We have one from Abram. Abram, go ahead.
I had a couple of questions. I know you're going to be touching on the EDAM and how they interact, potentially with the CRR markets. And I think one of my questions, which hasn't been clear from the EDAM discussion, is how the simultaneous feasibility test will, when you're allocating CRRs in California, will account for congestion in the non-CAISO BAs that are part of the extended day-ahead market, and whether you're going to ensure that those are honored. And secondly, what happens when California CRRs are flowing on external constraints that are binding in the market? Will congestion rents associated with external constraints, how will that impact the funding of those California CRRs? Because we've spent a lot of time talking about changing, for OAT rights, making sure that if those flows are, network service or point-to-point service, the LMPs are going to fund the OAT right based on where the congestion is collected. And I'm wondering if that also applies to CRRs, such as, when there's congestion in an external non-CAISO balancing area, how will that impact the funding of California CRRs?
Thanks, Abram, for the questions. If I'm not mistaken, we will be, if not covering those exact questions, we'll be talking about the general topics related to these later in the afternoon, and I'll just check with the folks who are going to be talking at that time. Let's see, I guess James Lynn is not on, but maybe others from staff can tell me, and Scott and Jim whether this would be logically, these questions would be logically put off to later on if there are discussions
And
in the
that's 100%
presentations.
fine if it's, you know, you want
Yeah.
to put it off to the EDAM discussion.
Yeah,
Well, I
I,
don't
th I
think
think
it's-
that's getting into details. I think these are topics that are going to be addressed, but Scott?
I don't think so. I mean, I think, you know, the DFB design, you know, the only thing that's gonna get awarded congestion rent coverage on the parallel paths is self-schedule, so, self-schedules firm transmission rights. So nothing in the CAISO would get the congestion rebate, as far as I can tell, for any flows that had on parallel constraints. But I don't know if that's something that actually happens. You know, I don't think there's been any discussion of whether that is an issue, and but it might be. You can imagine that dispatch from Southern California Edison to PG&E, some of that, you know, could potentially go around in a loop up. So
Yeah. I mean, I think it's sort of I mean, we spent a lot of time in the EDAM because of the Pacific Corp issue addressing the fact that congestion in California might result in Pacific Corp not being able to fully fund the rights that are there. But it seems, and the issue there was that, you know, there was an equal treatment. The currently filed rules are that, you know, congestion that occurs on a constraint stays in the area where the constraint occurs. In the future rules, you really not, you don't have that parallel treatment between California congestion and non-California congestion in terms of being able to fully fund the equivalent of firm transmission rights in the case of California, which is the CRRs.
but we don't really have the
If I
data
can-
in the public domain, but go ahead, Danny.
I was gonna say, if we can table this as been suggested till this afternoon, this does sequence really well with the plan discussion this afternoon.
Okay. Okay. So Abram, I hope that you'll be able to join us. And if the question doesn't wind up being addressed in the presentation or the discussion, that you'll pipe up at that point.
Okay, thanks.
Okay, thank you, Abram. Ryan, anybody else?
That seems to be it.
Oh, okay. Great. So we're ready now to go on to the first item on the agenda, which are market power mitigation metrics. And first, we'll have a presentation from ISO staff, Scott and Quinn, and that will be followed by presentations by MSC members Jim and Scott. And we're hoping to be concluding in the, you know, around 12:30, and then having a half hour for lunch. So so let's go ahead. Quinn, will you be going first, or Scott?
Yeah, thanks, Ben. I'll be kicking us off. Yeah, my name is Scott Lehman from the Market Performance and Advanced Analytics team. I'll be going over an analysis on BA market power mitigation, part of the price formation enhancements project. And then Quinn will be going over some deeper analysis on the grouping approach. Next slide, please. Yeah, so brief overview. I'll start with a quick review of market power mitigation. Then I'll get into some additional metrics on CAISO competitiveness. We talked about both of these topics in a March 13th price formation enhancements working group. So if you want to dig in more, I'd recommend those slides. And then Quinn will be going over some additional analysis on the grouping approach. Next slide, please. So starting with a quick review of MPM, we start with a full market run of submitted bids. Then we look at binding constraints and BAAs that are price separated, and we evaluate them for competitiveness using the Dynamic Competitive Path Assessment. So the Dynamic Competitive Path Assessment, or the DCPA, is where we evaluate constrained regions for competitiveness, and that's really the focus of this analysis. We then take the results from the DCPA and use them in applying the bid mitigation criteria to figure out which bids ultimately get mitigated. Next slide, please. So this is a high-level overview of that DCPA process. Basically, we take the top 3 companies that have the greatest ability to impact the flow on the constraint or in that area, and we label them as pivotal suppliers. We then measure whether there's enough supply to meet the demand on the constraint or in that area, assuming those top 3 pivotal suppliers are withholding their capacity as much as possible. The result of the DCPA is the residual supply index, which is a ratio of that amount of supply available with those pivotal suppliers withholding to the amount of demand on the constraint or in that area. If the RSI is less than 1, the constraint is not competitive. If it's greater than 1, the constraint is competitive. Next slide, please. So this evaluation gets triggered currently for WEIM BAAs when they have positive price separation between that BAA and the rest of the system. So that means that the price within that BAA is higher than the price of the rest of the system. So when the price is higher within a BAA, we check whether there's competitive conditions within that BAA. Usually this is caused by binding WEIM transfer constraints or individual ETSRs, which are the underlying transmission pieces that make up the EIM transfers in the import direction. The BAA as a whole is then evaluated individually for competitiveness by applying the logic of the DCPA to the participating resources within that BAA. And importantly, CAISO is not currently evaluated under this same paradigm. CAISO is assumed to always be competitive. So with our grouping approach analysis, we wanted to take a closer look at that assumption. Next slide, please. So this analysis represents that kind of counterfactual run trying to assess CAISO with the same logic that we currently use to assess competitiveness for other BAAs, which is not currently part of the market. So we set up the calculation to mimic the current logic to calculate the residual supply index for the CAISO BAA. And we used the second half of 2024 as our sample period. Next slide, please. So this table gives a summary of the results of applying the DCPA to CAISO in all intervals across that whole 6-month period. And what you'll see is that all the way on the right, we have the percentage of intervals that are non-competitive. And in July, we would have up to 16-ish% of total intervals non-competitive for CAISO. And that percentage drops as the months get cooler. An important thing to note, and that we noted in our prior presentation, is that this BAA level assessment is only triggered when there's positive price separation for a given BAA. It's a little bit hard to evaluate that for CAISO, but the CAISO EIM transfers were only import constrained in 3 FMM intervals in all of 2024, and all 3 of those intervals would have been competitive. So we don't expect that if this criteria had been applied to CAISO, we would have seen much impact in 2024. But this shows how competitive CAISO would have been in each of these intervals if that condition had been met and if we had calculated the RSI. I'm going to break this down by hour in the next few slides. Next slide, please.
So can we go back before we get into this a little more? Let's, I think when we're doing this test, we're assuming that anybody can, any supplier would withhold it. So we're including PG&E and Edison as suppliers that would withhold supply because they can sell at higher prices if to their retail customers from their generation if the price is higher. And right? They're treated just like any other supplier, right?
Yeah, that's correct.
So we're saying, could we meet the load in California if we didn't have any of the Edison and PG&E generation and one other. But they're regulated utilities, and I don't think they can do that. So, I mean, there's an issue here about whether this says anything about the degree of competition in California, or just about the way we're applying the pivotal supplier test. Right?
Yeah, that's a good point. Another thing to note is that net buyers are excluded from this calculation. So I believe Edison may have been a net buyer.
When you say excluded, what exactly does this mean? Does that mean?
Yeah, let me clarify that. So they're excluded from the list of potentially pivotal suppliers.
Okay.
So they're automatically not a pivotal supplier.
But their supply is still considered.
Yeah,
just that
their supply is still in there.
Right.
Okay,
but if
so
they have
They're just
one
not
megawatt
eligible to be
surplus-
labeled
Okay,
pivotal
so
supply.
PG&E is net long, but Edison is not during this analysis, it sounds like.
Yeah.
Okay. And sorry, Scott, did you have
Go ahead. Go ahead.
I guess so yeah, we will talk a lot more about net position, but I also was curious within these 16% of hours how this interacts with internal congestion as well. So if there's congestion within the CAISO footprint, that would trigger mitigation of, some subset of plants as well. Is that a factor in these numbers at all, or you're sort of kind of ignoring that influence and just kind of considering this is what it would look like if it was just the BAA wide, sort of with no internal congestion?
Yeah, that's a great question. And yeah, the answer is this is what it would look like if there's no internal congestion. Doesn't look at that internal congestion at all.
Okay, so if in reality a bunch of these hours had, say, path 15 congested, then there would be, I don't know how many, but there'd be a bunch of units that would be mitigated because of that, that this analysis is sort of assuming, at the first cut would not be. I'm not sure the right way to try to think about that, but I just wanted to kind of clarify sort of what the 16% meant. Thanks.
Yeah, that's a great point.
I guess one other point is here we're saying it's only import constrained in 3 FM intervals. That's for all of the EIM, which presumably this is when we failed the resource efficiency evaluation. But we could be constrained off from, say, the Pacific Northwest and in a bubble with, the Southwest. And then that would trigger that would trigger the grouping, and then this test would cause us to fail every night, every hour.
Yeah, that's a good point. I see we have a hand raised. I might try to get through the next. I only have 3 slides left, and then take some outside questions. So when we look at which hours within the day were non-competitive, they're pretty much all in the evening peak hours ending 18 to 22. And as we noted in the prior table, they're really concentrated in the summer months. So this just shows July, August, and September. And you can see hours ending 18 to 22 are mostly or all non-competitive. Next slide, please. And then as we move into October and through December, those percent of intervals drops, and we still see it just in the evening peak when that solar ramp is coming offline. So one more slide. So as a summary, CAISO would often be non-competitive during solar ramp down / evening peak hours during the summer based on the current test as it's set up today for other EIM entities. And kind of some intuition behind that. So we're looking at whether there's enough upward ramp to meet the demand when our 3 largest participants are ramping down as fast as possible. So when we are also seeing all of our solar come offline, the answer to whether we can still meet demand is oftentimes no, especially during the summer peak.
A question about this. When we say they're ramping down as fast as possible, even if that were wind offered at -15, we'd be assuming that they would be ramping down?
Not if they've self-scheduled, but if
No,
they,
if they offered at -15, would we withhold that supply?
if they were part of the, yeah, if they were part of the pivotal supply and they could ramp down, then we would evaluate them. Yep.
But they wouldn't be ramped down if they're offered at -15, right? If they're
Well,
offered
the
at
idea is,
-15, they can't ramp down. They'd be, unless the price was negative, in which case we wouldn't care.
yeah, fair point. I think the analysis is trying to evaluate if the pivotal suppliers took out as much capacity from the market as they possibly could.
But they
I
can't,
think we
not if
do.
they've offered it at -15. I mean, there's an issue here about,
Sure.
the reality of this test in an era of intermittent resources offered at 0 and run-of-river hydro and
Yeah, point taken.
because we actually, this is not something that's done months forward. This is actually looking at a specific FM interval where there are offer prices in there.
Yeah. I think we have a question from Callie.
Kaylee, you're unmuted.
Hey, it's Callie Wells with WPTF. Can you guys hear me okay?
Yes.
Great.
Yeah.
I actually had a question on the slide Scott was asking, I think the first slide where it kind of showed the percentage of intervals. Because I kind of want to make sure I understand what is included in like that 16%, because I know you guys presented analysis in PFE a couple, I don't know, maybe a month or two ago that only identified those 3 FMM intervals as the ones that would have been tested. So that analysis basically said CAISO would have only been tested in 3 intervals of all of 2024, and they were all competitive. So I'm trying to reconcile that analysis with this analysis. So what additional intervals are included in the 16% that were not originally included in the analysis a couple months ago?
Yeah, that's a great question. Thanks, Callie. So this analysis looks at every single interval in the month, every single FMM interval. There's some slight differences in the total intervals in the month, which is that total intervals column. Sometimes we miss an FMM interval for a variety of reasons. But this analysis looks at that RSI calculation in every single interval, as opposed to just the intervals where CAISO EIM transfers were import constrained.
Okay, so this.
Does that answer your question?
Yes, and that helps a lot because so essentially what the 16% is including are tight supply days. So CAISO still has potentially access to competitive supply through transfers, and what it's capturing now. So I guess maybe I look at that 16% and I'm like, a subset of that might be quote unquote non-competitive, but a lot of it might also just be tight supply conditions. And I don't know if we necessarily want to be mitigating in those conditions. That's when you risk over mitigation and you want that price signal coming through. So if I'm understanding that right, that 16% includes tight supply days where we still have access to competitive supply.
Yes, I think
Okay.
that's right.
That helps a lot.
We can talk about this more, but yeah, I mean, tight supply and
It's a fine line,
competition is a complicated sort of interaction.
Yes, but based on the trigger, we actually wouldn't have been triggered to be tested in all of the intervals that you're showing in your analysis. So that helps me reconcile the two. Okay, that helps a lot. Thank you so much.
Any other questions in the queue?
Nope, that appears to be it.
All right, great. Then I'll turn it over to Quinn.
Thank you, Scott. Hi, this is Quinn from Market Performance and Advanced Analytics. Can you hear me okay?
Yes.
Okay, sounds good. Let me start. So in this second half of the presentation, we'll discuss the grouping approach. We share the results of the updated counterfactual study as the impact analysis of this approach. And then here is a summary page. At a high level, our current approach tests each BAA individually, and it does not consider supply contributions from the other BAAs. In this, from the previous discussions, may lead to access mitigation. Now, if we consider a grouping approach, it evaluates BAAs within subsets or bubbles, bigger bubbles. It potentially reduces unnecessary mitigation and more accurately reflects the actual market conditions and competitiveness. The detailed concepts were covered in the previous stakeholder meetings. I'm not going to go over them here, but we'll start with 2 examples to get a refresher. Next slide, please. Right. This first example, well, let me just talk about the graph. So on the right, we're looking at the BAA connectivity map. If there are non-base ETSRs defined between the 2 BAAs, it appears here as a link, showing that the 2 BAAs are directly connected. This is a term in the proposed grouping approach. Since the ETSRs are defined in pairs, the graph is undirected here, meaning the connectivities do not have a direction. This node layout loosely illustrates the geographic regions. So Pacific Northwest position in the upper left, Central Mountain in the upper right, California in the bottom left, and Southwest in the bottom right. The BA abbreviations are in the circles. This structure helps to provide a visual reference for understanding the BA interactions and the group formation later on. Here I'm taking the first data point from September 4th, 2024, hour ending 13. This is middle of the day. The original results, we saw that there's a subset of BAAs where got the results as non-competitive. That's if you read the list, it's pretty much everything about the red line. So Pacific Northwest was uncompetitive, and the other half, more than half, the other set of the BAAs are competitive. So that's everything below the red line. That's Central Mountain plus California plus Southwest. Next slide, please. In the grouping approach, we start by looking at the BAA marginal energy component, and the prices can be partitioned into 3 groups. Group 1 start with BCHA at $42.48. That's marked in red. Group 2 BAAs were at $37.93. That's everything in blue. And the third group was the everything in green, that's at $32.33. So the 3 MEC groups are marked in colors to help us to visual their locations. Next slide, please. Finally, we can go through the grouping approach. We first start by testing group 1, come back to fail. So we mark group 1 BA as non-competitive. Then we go to group 2 because it's directly connected with group 1. So we bundle them together. That's testing group 1 and 2 together. It passes test. Then we mark group 2 BAs as competitive. So everything in blues is competitive. And then we get a roughly $38 as competitive LMP for group 1 BAA. And we could go to group 3 because, again, they're directly connected. So we test group 1, 2, and 3 together. The full test passes. Then we marked group 3 BAs as competitive. Note the results here. Group 1 BA remains fail from the original to the new results. Group 2 BAs flipped from a fail to a pass under a grouping approach. And then group 3 BAs remain pass with this new approach. That's the end of the first example. Next slide, please. Then we look at a slightly different setup with example 2. This data point was taken from August 12, 2024, hour ending 21. That's peak hours. Original results, no one was tested. All the BAs were categorized as competitive at that time. So if we go through the grouping approach here, we start again with the MEC groups. Group 1 marks as red. That's at $51.55. That's BCHA plus California plus Southwest and Pac East. So everything red. And group 2 was at $49.75. That's everything in blue. And group 3 was at $46 roughly. That's everything in green. Next slide, please. We finally go through the grouping algorithm again with this example. We test group 1. It fails. Note that, sorry, let me add this one additional insight. So in this round, because we saw the part 1 results from Scott's presentation, we tested CAISO along with everyone else in this round. That's why the results come back differently from the previous presentation about a couple months ago. So even though CAISO was part of the test for test group 1, we still tested with the rest of the group, and it came back as a failure. So the group 1 test failed. We mark everyone in group 1 as non-competitive. Then we go to group 2. We test them together, 1 and 2. It passes the test. We mark everyone in group 2 as competitive. That's everyone in blue. We get the 49.75 competitive LMP for group 1 BAs. Then we move to group 3. We test essentially everyone together, and it fails. So we mark group 3 BAs non-competitive, but there is no competitive LMP generated for group 3 BAs because that was the last test of this approach. That's the end of the examples. Any questions before I move on to statistics?
Well, it looks to me like we got, what happens is you go, when you add the CAISO and then you take out PG&E and maybe you also take out Edison, you cause it to fail because you're hypothesizing that PG&E regulated utility is treated as if it has market-based rates and can withhold supply in order to raise the price for its retail load, when in fact it can't. And it's so big that it, I think just says this whole methodology becomes broken because of that assumption. And that the wider the area we test with that assumption, the more people will fail.
Well,
the other
yeah,
in the
so
middle of the day when we had all the solar.
yeah, we conducted these counterfactual studies under the current assumptions, right? So we're trying to follow whatever rules we have today and see how that works with the counterfactual study, and this is the outcome we saw. So that raised some good policy questions, I suppose, for us to discuss and think about.
All right, we do not have any raised hands at this time.
All right, so let's move on. Next slide, please. All right, so next we're going to look at some statistics out of the counterfactual study. Here is a list of factors that we considered in this analysis before we dive in the numbers. The range we took was the summer 2024 Q3 data. Potentially that was the sensitive time we wanted to look into a little more. The past we were taking from FMM 50-minute market LMPM results. One simplification was that master file registered ETSR mapping was used as the reference for connectivity among BAAs. That's why we saw the connectivity in the examples we illustrated just now. And competitive LMP of the passing group then is set by the lowest MEC in the group. That's one more condition. And finally, this one is the new update. CAISO is not assumed to be always competitive. So this condition drives the changing results that we see starting next slide. Next slide, please. Here we're looking at the original overall pass rate. The BAA here is considered as a pass in the BA level NPM if it is not import transfer constraint or it passed their RSI test. This is before. So original pass rate, the number of BAAs on the y-axis, that's a count. Those are grouped into bins of pass rate percentages on the x-axis. So percentages are on the horizontal axis. With the original results, we saw that 15 BAAs passed about 95% of the time or higher. That's the far right category. Next slide, please. Then this is the new results with the grouping approach and also with CAISO tested as part of the team. The first observation is that majority of the BAs remain 65% or higher pass rate, still under the new grouping approach, but the overall pass rate dropped for all of the BAAs. Next slide, please. Okay, this table summarizes the results at the BAA level. We start the columns of the BAAs. We start with the BAA name, that's the first one. Then pass rate original, the second column is the percentage of pass in the original approach. Third column, pass rate new, that's percentage of pass with the grouping approach, and also with CAISO being part of the test. Pass rate delta, that's the delta change between the two approaches. We saw that majority, all of the numbers were negatives. And the last column, fail given pass, is the conditional probability, conditional rate, the percentage of previously passed BAA test that failed under the grouping approach. So roughly we're looking at something range from 12% to 14%-ish in this last column. And on the right, we have a small table there. This one is a transition table showing the movement between the passes and the fails. 79% of the cases remain passing. Then 8.6% of the cases remain failing. 0.25% cases originally failed and then passed under the grouping approach. Then lastly, roughly 12% of the cases dropped from pass to fail. Next slide, please. Now we're switching to a heat map. This heat map visualizes the pass rate patterns at the BA level over the hours of the day. So each row there represents one BAA. We start with Southwest, and then they're bundled roughly together. So the first set, we start with the Southwest, and then going to Pacific Northwest, and then the Central Mountain and California at the bottom. The x-axis shows the hours of the day. We go from 1 to 24, and there's a color code. The colors indicate the pass rate. If it's white, it's 100% pass. So if it's really light color, it passes all the time at that hours of the day. Down to blue, 75% of the time. Down to yellow, that's 50%. Down to pink, that's 25%. Down to red at 0%. So the colors roughly indicate how the pass rate came out to be in the original setup. And we saw that the majority of the failures occurred originally in the midday hours, or primarily due to the solar supply in the system. So primarily the solar hours of the day. Next slide, please. Now it's the same thing under the grouping approach with CAISO being part of the test. The first observation from the result is that most of the entities are filling during the peak hours under this new approach. That's majority the hours of 19 and 20, especially in the pink to red color codes, and that aligns with the observation we saw earlier. Next slide, please. Here is the box plot. So the box plot shows the number of groups formed over time throughout the study period. The y-axis represents the numbers of the groups formed, and the x-axis as the hours of the day. We can see that there's fluctuations and variations of a group formation throughout the day, but most of the time it's 2 to 3 groups formed, and in some hours up to 4 groups formed. So there were 2 outliers up there in the 2021 number range. That was an outlier case. It was August 29, 2024, Arting 4. It was this one instance where all the WEIM participants lost connections to all the market applications. Because of that, all the ETSRs went to 0 due to the system issue. So that was pretty much, if it's not the worst case, it's close to the worst case we'll see in the system. Next slide, please. All right. So after that, we look at percentage of intervals having any BA without a competitive LMP. What this means is that, okay, let me take a step back. Remember from the example 2 we saw just now, there was this last test that failed everyone together. So this last test of the grouping approach in the study is testing with the whole WEIM footprint, because I was using a master file definition ETSR mapping, right? So everyone was connected together. If this last test fails, then some BAs may not get assigned a competitive LMP out of the grouping approach. That was the last group in example 2 we saw just now. So here is the percentage of the intervals having any BAA without a CLMP under the grouping approach. And we saw that this number the frequency was high during the afternoon peak hours. And so there's a natural question, what price is to be used under this situation? This remains as one of the policy questions for discussion. Next slide, please. So the next question could be, well, we saw that was any BA without a CLMP. So how many BAs did not see a CLMP from this grouping approach? Here is a representation. So the number of BAs were counted, grouped down here as a count. Bucket gray was 0 to 5, blue 5 to 10, and the yellow was 20 to 23. There was a gap between because the count was 0. So we saw that majority of the BAs were not assigned a competitive LMP during the afternoon peak hours when the last test fails. Next slide, please.
Just a second, I'm trying to understand. I would think if the last grouping fails, then there never be a competitive. How can you have a competitive LMP if the group that includes everyone fails?
Right, so remember this proposal, the design of this approach assigns a competitive LMP to a previously failed BAA when it passed the first time. So remember in example 2, we just saw when we test group 1 and 2 together, it passed. So everyone in group 1 got assigned a competitive LMP because the second step passed. That was the first time it got a pass. So that they got assigned as a competitive LMP from here. And we moved on to the third step. When we test everyone together, it fails. Then the group 3 BAs were not getting a competitive LMP, but it does not impact the previously assigned competitive LMP for the first 2 groups.
So
Does it make sense?
you test the highest price group, and it gets a
Mhm.
competitive LMP based on the prices in the broader area, but then you say the broader area isn't competitive. I don't get it.
We conducted this test in steps. So any of the intermediate step passes, it assigns a competitive LMP for everyone previously deemed as non-competitive in this proposal.
I just don't see the logic of doing that when, if you actually found that the entire region was non-competitive, why would you say that, why would you assign a competitive LMP based on the non-competitive prices?
Yeah, I guess intuitively, if we only look at a subset of the region, even if the whole WEIM footprint, when we test it together, it fails because we took out the 3 pivotal suppliers and withheld the capacity from them and so on. If we zoom into a subset of the region, maybe the subset will be competitive when we conduct the test. So this is the outcome of that.
I guess so.
All these assumptions are open for discussion, I suppose. So any comments will be welcomed.
Scott, this is George Angeles with you. So I may want to add here that even if the entire group of all BAAs at the last stage of this process is found to be non-competitive, it is potentially possible to have any cutoff of that in the process as you build towards that overall group. You can find a group in the process in the intermediate stage that is competitive. And the lowest marginal energy cost of the BAAs in that group is used now to mark the competitive LMP for any BAAs in that group that have previously found uncompetitive. That is the essence.
Muted, Scott.
Oh, go ahead, Jim. You
no, I was just letting you know you're muted.
Yeah, but George, the thing is, if the competitive LMP is being set by the price in a grouping that is uncompetitive, then why is it a competitive LMP?
Oh, it is competitive for the group that passes the test.
No, but it's the competitive LMP, George, is the one in the outside region, which you say is non-competitive. So if that's a non-competitive region that fails the test, why is the price in that region setting the competitive LMP for the region with, the narrower region? I mean,
maybe there's a misunderstanding. That's not what we're saying. We're saying that if you find a group that is competitive, and in that group, there are BAAs that were previously found to be non-competitive, so now you're seeking for a competitive LMP for these BAAs. If they eventually join into a group that is competitive, now you can set up the competitive LMP for these BAAs because you have a competitive group at this stage.
No, but why don't we go back to slide 16 so we can look at this and see what we're talking about. So if we got up there, the PowerX fails, and then it passes with group 2, and then you'll say that the group 3, that sets the competitive LMP for BC Hydro.
The second group, where we test groups 1 and 2 together.
An example, because it's got if we had the maybe we should go to group one. That's a clear example because we got two unconnected.
One's all
groups.
over the place on this one, yeah.
Yeah, right. Go back a couple
One
slides.
here
So,
is
yeah, here.
group
Here,
one was.
so if group three were if the whole thing with group three was non-competitive, why would 3793 be a competitive LMP if that's higher than the price in the non-competitive region? So why is it a competitive LMP?
But that's not the example here. In this test, the group 1 to 3 passes, and the group 1, 2 passes.
But suppose it failed. Suppose it failed, George. I mean, the question is, we have all these
okay.
cases where 1 to 3 fails, and that that was the diagram. That 1 to 3, the test including everybody failed, but we still have a competitive, price for some subgroup. But that's what this is. Suppose that it failed for everybody, for groups 1, 2, and 3 together, but groups 1 and 2 passed.
Right. Okay. So we're changing this example. Let's say at step 3, the entire set of PAAs, which is groups 1, 2, and 3, fail. Right. That's what you're saying.
Yeah. Right.
All right. But in stage 2, where we have groups 1 and 2 together, that set of BAAs is a competitive subset. So the LMP, the lowest MEC in that group, what is it, 3793? That is a competitive LMP for that entire group. And of course, for the BAAs in group 2, we don't care. They're already passing. They're marked to be competitive. So we're not looking for a competitive LMP for them. But one, BC Hydro, in this case, that failed, and we know that it's non-competitive. Now we can argue that the 3793 is a competitive LMP for the group because it is the LMP for the groups 1 and 2 that is competitive now. That's the argument.
Okay.
Even if later on, when you add more BAAs, the whole set fails, still that subset of groups 1 and 2, it's still competitive.
But so we're saying that even if the true price in group 3 was $20, it would still be constrained off from groups 1 and 2. So group 2 would still be competitive. I guess.
Right. Because it's still import constrained from group 3, right?
Right. So the supply couldn't increase if the prices went down in group 3. Okay. I think that makes sense now.
Thank you for the question, and thank you, George, for jumping in to answer the questions. So this is my last slide. I was going to go over the last slide. We measured the delta of how far the original MEC was from the competitor LMP generated from the grouping algorithm with CAISO part of the test if the test failed in the study. X-axis is hours of day 1 through 24. Y-axis is percentages. It's a proportion of the price buckets. At each hour, the price buckets are showing in the legend down there. We see that price. So majority of the time, the MEC to competitive LMP difference fall between $0 to $20 for non-peak hours of the day, and for the peak hours of the day, the biggest group was the group with non-competitive LMP. That was the end of my presentation. Any follow-up questions?
That was great. Thank you.
I guess there was there was a confusion on the second example. Can we go back to the second example? I think page 16. Right. There were 2 group 1s marked there. Group 1 was everyone in pink or red. In this case, because CAISO was not importing, but it was exporting through EIM transfer. It was exporting to BCHA. That makes them the same group. So BCHA was in the same group with the rest of the BAAs down there in red. That's why I marked them together. Okay, that's the end of my set.
Okay, thank you, Quinn. We can check Ryan if there are any questions on the line.
Yes, we do have a hand raised from J.K. Wang. You are muted.
Morning, Quinn. Thank you for the presentation. This is J.K. Wang from PGE. I just want to make sure I understand the slides right. You mentioned that the passing rate decreases after we applying the group method. If I recall correctly, previously we had this initiative because we're concerned that some of the BAs got over mitigated without their external supply considered. But it seems that after changing approach, what was mitigated will still be mitigated, and their mitigation rate will increase. Is that right?
Right. So you're talking about the last set of results we presented last time, right? Last time we conducted the counterfactual study with the grouping approach pass rate without testing CAISO. So that was for what we call an apples to apples comparison, because that is the assumption we have today in the system. When we just apply the grouping approach to the system, but whenever CAISO is part of the subset, we give it a pass automatically, then we see an increase in pass rate. That was the results last time. And this time, since we look at the CAISO competitiveness from Scott's part just now, we lifted that condition in the study to show the new results. If we test CAISO as part of the test with everyone else and what will be the outcome, then that's the results. That's a pass rate we saw just now in the second round. And the result is that we get a lot more failures in this round.
I see.
So,
That's
yeah.
really helpful. Thank you, Quinn.
Thank you.
Okay. Thanks, JK. Ryan, do we have any others on the phone?
We do have a hand raised from James.
Okay.
James Friedrich.
Hi, this is James Friedrich at the California ISO, and I wanted to actually pitch something to the MSC on this slide for discussion. So the algorithm, as it's programmed here, assumes that you continue the test, the grouping test, all the way through till the entire market is tested. But in this case, Group 3 has lower prices and therefore is exporting to a competitive Group 2. So my question is, does it make sense to continue to test Group 3 in this case when it is price separated in a downward direction from a competitive group? And my thought being that, well, if suppliers in Group 3 tried to exercise market power, the shadow price of that BA's MEC would go up, and therefore receive the direction of the flow would shift, and they would be actually receiving competitive supply from Group 2 in that counterfactual. So one thing I'm wondering is once we find a competitive group, should we automatically deem any group connected to the competitive group also competitive for these reasons? Thanks.
Well, I guess the problem with that approach is, I mean, suppose that right now Group 2 caps the price of Group 3 because Group 3 couldn't. Suppose there were really that 6 of those balancing areas were tiny and 1 was huge. You know, right now it can't raise the price above $49.75 without reducing exports. But suppose the Group 2 price was $90 and the Group 1 price was $120, then there'd be a lot of room. Or maybe, even as it is, suppose the price in Group 3 should be 12, but they've raised it to $46.18, just below the price in Group 2. You know, they didn't get it quite right, but that was, you know, the price at which they thought they could raise it without attracting exports or attracting imports. So this could be the outcome of the exercise of market power, that they've You know, if there really was one company that, or one balancing area that was highly concentrated, and they knew that they couldn't raise it without end, but they could raise it up to something under $49.
Scott, if you could, Ryan, could you show slide 15? And Scott, could you say that just once again, because I know you were talking about this slide. Okay, so forgive me for asking you to repeat that, but
Okay,
I was trying to follow the wrong slide.
No, but it's the same prices.
The same picture, yeah.
Yeah, it's I'm saying that suppose the true competitive price in group 3 was $12. And they've raised it to $46.18 because they knew they couldn't raise it too high, because then they would lose the exports to group 2. So they're raising it as high as they can to keep the price high within group 3, but not lose the exports to group 2. Because this could be this could be outcome of attempting to exercise market power, or successfully. I mean, without knowing what the true competitive price in group 3 is, you don't know. That would be what, if I really had a cost of $12 and I really had market power, I would try to raise it just under that $49 price. And 46 might be my best, my best guess, because you can't figure everything out. So that's the problem, I think, with assuming that if there really truly was market power in group 3, that's what they do. They try to raise it. Now, if the group 3 price were far below the group 2 price, then you'd say, well, it doesn't look like they're very successful in exercising market power. But that, that's the point, that it doesn't look like they're very successful in exercising market power if the price is that low, that far below exports. But
All right, so the bottom line being that even if a later group has a lower price, you should still test it, because they may be exercising market power, pulling the price up for their consumers, and but not up to a level that allows imports to compete for their consumers'
reduces
business.
exports. Yeah, they want to export as much as they can at that high price too.
Right. Okay. All right. So does that make sense? And I'm sorry, Danny, was that you, or was it somebody else who?
James Friedrich.
James, sorry.
Yeah, I appreciate the discussion, and I'll think about it some more. But it's one of the questions that we've been, grappling with in terms of policy, is how long should the test continue? And in this case, it continues for the entire market footprint. And that's one of the considerations for, in some cases, stopping the test after you find a competitive group. But I'll think more about the feedback.
Great.
Okay. Ryan, have we got anybody else?
Yes, we do have a hand raised from Callie Wells. Callie Wells, you're unmuted.
Hi, it's Callie Wells with WPTF. I actually wanted to go real quick. I had a question on the analysis, so kind of back to JK's question. When we're adding CAISO to the grouping approach, honestly, that result that now we've increased mitigation seemed a little bit counterintuitive to me when we were adding more supply to the test. But I wanted to confirm, I think we got the answer for Scott's analysis, but on this analysis with including CAISO, was PG&E, SCE, and San Diego excluded from being potentially pivotal supplier, or were they ones that could have been removed when you calculated the RSI?
Are you talking about the CAISO test alone or the grouping approach?
The grouping approach when you included CAISO.
Right. One reason it might have failed is that because when you expanded to CAISO, you withhold PG&E and Edison supply, and all of a sudden the region becomes hugely deficit.
Exactly. So I'm wondering if we exclude the net buyers like we do today for CAISO for local market power mitigation, we might see drastically different results.
Right.
Yeah, I think the issue is the net buyers are no longer net buyers in some cases.
Yeah, so is that how they were treated in the grouping approach analysis that you just went through?
Yeah, so it's the same logic, but expanded to the WEIM footprint. So we have more affiliations to choose from, in addition to the CAISO list, right? It's interval by interval based, so I don't have a static list to provide who was the top 3 suppliers. But the first step was to filter out the net buyers so they're not considered to be a pivotal supplier. And then for the net sellers, as of the using the definition today, who would be the top 3 pivotal suppliers, and then those will be the ones withholding their capacity from the test.
Okay, so just to confirm, when you included CAISO in the grouping approach, you did not allow, let's assume SCE was a net buyer. You did not allow them to be a potentially pivotal supplier.
Right.
But if they were a net seller by 50 megawatts, you'd withhold all their supply.
True, yes.
Okay, thank you for clarifying. Yeah, I appreciate that, thanks.
And my understanding is earlier versions of this just took the kind of blanket assumption of CAISO being competitive, and that kind of spilled over to the other regions when you did previous versions of the grouping test, and this no longer does that. And so that's, I think, a big difference.
That's right.
Okay. Any more questions in the queue?
Those are the last questions.
All right.
Okay. So now we're go on to Jim and Scott have presentations. We were scheduled for lunch at 12:30. We may hit that. We may go over a little bit to accommodate the 2 presentations.
Yeah, I'll try to go a little bit quicker. Okay, so the idea here was to first cover some high level kind of placing mitigation in the context of broader kind of competition antitrust policy. Just remind ourselves about that. And then kind of zero in or hone in on 2 proposals without specific elements to those proposals, but basically to try to, honestly, we kind of thought the discussion by this point would be along how to do these things, but it's still like at the stage of if we should do these things or it hasn't even been thought of. So this is not how to do those things, but we definitely want to sort of raise their visibility here so we can start talking about how to do them. All right, next slide, please. All right, I'll go quickly here, but I guess the point of these first couple slides is to just remind everybody how unusual bid mitigation is in the realm of competition policy, that generally it's very unusual for a regulator to kind of in a generally unregulated market to sort of say, okay, we're going to reset your selling price. And energy law is different than general antitrust laws. There's just and reasonable standards and other things that sort of, place a higher responsibility of oversight. But it is still very unusual to have what we call mitigation, this kind of active mitigation of offer prices, even in the electricity industry outside of the United States or other industries. And the reason is generally that it's pretty hard to kind of know what to mitigate to in most industries. Very hard to come up with a credible estimate of marginal cost. And it's generally viewed to be kind of costly to second guess the business decisions of firms. All right, next slide. Now in electricity, we do it because there are some circumstances where market power can be extremely costly and harmful. And so if you apply sort of a cost benefits test, it's a kind of, it's a strong tool, sort of a heavy-handed form of regulation, but in some cases it's warranted if market power can be severe. And there is sort of, we don't think there's any competitive dynamic that will mitigate it. And general, antitrust law thinks about things being chronically uncompetitive. But even if it's just transient market power, it could be very costly given, just the fundamentals of electricity supply and demand and the inelasticity of demand and those sorts of things. And then one last point, that it is electricity, unlike most markets, is cleared at a uniform price. And so a lot of times, even if we mitigate the bid, we're mitigating offer prices and not the prices received by firms in many cases. And so going back to like the earlier discussion of super tight markets, what we'd like to see is firms able to earn extremely high scarcity prices when markets are very tight, but not necessarily by having to bid very high to get those prices. And so the idea is, mitigate or allow firms to bid something close to their marginal cost, but allow them to earn that scarcity. And that's kind of an important distinction between electricity markets and other contexts. All right, next slide. Now, with all that as background, we see growing challenges to the traditional mitigation approaches. Scott's going to talk a lot more about kind of some specific gas price issues, CC-Debye context, and those sorts of things. But in general, if we have a less clear picture of what the true gas price is, because either liquidity or timing or other things, then it becomes harder to come up with an accurate picture of what a gas unit's proper DEB or marginal cost would be. But it gets even more complicated when we think about alternative resources. We've spent a fair amount of time trying to think about what the right opportunity cost would be for things like large-scale hydro that have long duration storage capability. What's the right value of water? And we use things like ICE futures and things like that. But I don't think we should be confident that we're nailing that number super accurately. And when it comes to short duration storage, we've had sort of a lot of discussions there about what the right measure of opportunity cost is. It's very difficult in real time where we don't have a 24-hour sort of window there. And so again, I don't think we can be particularly confident about really kind of capturing that well. And that's not even getting into whether and how we would mitigate variable energy resources. Should we worry about wind or solar units withholding from the market? How would we even police that sort of thing? And then in addition, the consequences of false positives, going back to this kind of cost benefit kind of trade-off, the consequences of a false positive, of mitigating a unit that maybe shouldn't have been mitigated, given that we have a less clear picture of what their true maybe opportunity costs are, I believe are getting more severe as our systems evolve. And in the old days, if we're mitigating a gas plant and we just kind of got its costs a little too low, there is a process. It's not it's not without its burdens, but there is a process of trying to go to FERC and recover costs if they can demonstrate that their costs truly were above what the mitigated prices were. But it's a different situation if we're talking about draining a battery too early in the day. And I know we've had discussions about how this doesn't seem to have been happening, although I think there's still some mysteries to explore there. But it's certainly a prospect that I worry about. And when you think about that sort of thing, it affects the actual physical operations of the system. It's not something you can easily kind of rectify in a ex post sort of appeal to FERC. All right, next slide. All right, so the spirit of the rest of this is thinking about how to kind of focus, bid mitigation, which is this kind of very powerful tool that can cause unintended consequences. How to try to focus it on the situations, the regions, the times where it is most needed. And try to not apply it in cases where we think it really wouldn't be needed. and two specific proposals along these lines. We've talked a lot about this already. I'll dig into it a little bit more, though, is to apply some metrics of net position or better metrics of net position. They could be static measures, they could be dynamic measures. Again, I thought we'd be having a discussion of how to do this at this point, but we want to emphasize that we really should start that discussion. 2 decades of research has shown that this is a really dominant influence on spot market, day-ahead market, real-time market behavior. Next slide. Okay, so to just walk through the intuition here, very simple Econ 100 kind of stuff. Imagine that you're selling, first that a firm's just selling all its power into a day-ahead market. And so the Q here is that firm's quantity that they're selling into the market. The revenue it would get would be the price in that, call it day-ahead hour, and the quantity it's selling in that day-ahead hour. The price here, notice, is in some curly brackets, implying that if it changes its quantity, it has some influence on the price. And so there is some ability to affect the price. And when we think about firms' incentives in this kind of context, we think about its marginal revenue, which is this lower equation, which is going to be, okay, what would happen if I push 1 more megawatt out into this market? Well, there's 2 components to that. What's the change in my revenue if I push 1 more megawatt hour out? Well, first I earn the price on that 1 megawatt hour. That's what that first term P of Q is. I sell 1 more megawatt hour, I get the price for that. That's the good news if you're a seller. The bad news if you're a seller with market power, good news for the market, bad for the seller, is that you're also changing the price if you push 1 more megawatt hour out. That's what this delta P implies. You're changing the price, and that's, if you push more power out, you're going to decrease the price. So this delta P is going to be negative. So that's the trade-off for a firm exercising market power. They could increase their output, but if they do so, and they get to sell more stuff, so they get the price, but if they do so, they're also going to lower the price. How much do they care about whether they're lowering the price? Well, they care basically scaled to how much quantity they're already selling. So that's what this change in price times quantity means here, that second term. They're lowering the price, and they're lowering it on all of their sales. So if they go from Q to Q plus 1, they're lowering the price on Q, maybe by a little, maybe by a lot. And so how big Q is really affects their incentives and strategy, how much cost they're willing to undertake in order to exercise market power or not. So next slide, please. All right, so now let's think about, okay, well, what if we're focused only on the spot market? Maybe this is the real time and QC is the day ahead, or we can discuss what forward commitments really mean. But the idea here is there is a bunch of sales that have already been spoken for, either through a forward contract or through some kind of retail commitment, where basically you're not selling everything at the spot price anymore. You're selling a big chunk of your total output at some price that's determined outside of this spot market, either through a forward price or through some kind of regulatory process. And so the real Q that's exposed to the spot market, call it day ahead or real time, is not the total amount of your production. It's the residual amount after accounting for the quantities that you're already committed through some other channel. And so revenue, I put a little S subscript here. Revenue in the spot market now is going to be the spot market price times the net of your output minus the quantities that are already spoken through some forward, retail, or other commitment. And marginal revenue, if you break that down, becomes, okay, now if I push 1 more megawatt out, I still get the spot price for that extra megawatt, and I'm going to lower the price on the other ones, but how much of the other ones do I have now? It's not my full output anymore. It's just the residual that was available to the spot market. And if you think about QC being, kind of this continuous measure, and I'm going through this because I really want to emphasize the fact that this isn't a binary dynamic. If you are 1 megawatt long, that's a very different incentive than being 10,000 megawatts long. And being 1 megawatt short is different than being 1,000 or 10,000 megawatts short as well. And so the difference between Q and QC is a continuous effect here. And if QC equaled Q, though, this second term just goes to 0. Because Q minus QC would be 0, and you basically have a firm whose marginal revenue looks like a perfectly competitive firm. All right, next slide. And now if we think about how this translates to sort of oligopoly frameworks, I'll go quick here. Basically, the idea is as demand gets higher, if you did a sort of different types of non-cooperative equilibrium outcomes, the range between competition and non-cooperative can grow. Next slide. We think of forward commitments. Next slide, please. Drum roll, as lowering the range of those commitments. And I didn't, also, if you look to the left of that crossing point, you can also have a situation where a firm that might be really net short by a very large amount, if they have the right types of generation, could also offer in a way that profitably for them would be to lower prices, would be their strategy if they're net buyers in the market. Generally something we don't sort of focus on in bid mitigation. All right, next slide, please. Okay, this is my ballpark attempt using EIA data, trying to figure out what these Qs and QCs, would look like for a bunch of the EIM participants, using the generation from EIA data and the load commitments from EIA 861. Now, my generation numbers, this is just stuff that's registered as owned by these companies, so it doesn't track things like PPAs or solar, renewable contracts and those sorts of things. So DMM and other market monitors can do better than I can just using sort of federal data. But the general idea here is if you match these retail commitments, which I think is the left-hand bars here, with the generation commitments of some of the largest firms in the EIM, some are net long, some are net short. As we already discussed, PG&E is now net long in terms of having more generation than supply. Edison is still net short, but there's a balance here. And again, it's not a binary. It's not that, oh, I'm 1 megawatt long, so I can exercise market power over my entire portfolio. We want to think about what the difference between the two are when thinking about how much incentive firms have to exercise market power. All right, next slide, please. So that's
Jim, if I read that, sorry to interrupt, this is Ben, but it looks like most are net buyers, right? Am I interpreting that correctly?
Well, I don't want to push this too far because this is kind of off-the-shelf data that doesn't include secondary contracts. So if some firms have tolling arrangements with other firms, they wouldn't necessarily show up in EIA data as controlled by a specific firm. So the short answer is yes, but that's with a very cursory set of data without a full exploration. Okay, so I think and again, we'd like to have a discussion of how to do this, but emphasizing, I think it's really important to measure this, and the results we just saw from CAISO over the last 45 minutes really sort of, I think, bring home the import of trying to consider net position. Certainly if we're doing kind of system level or BAA level mitigation, and ideally even think about it in terms of local market power mitigation. All right, so the other proposal for thinking about mitigating mitigation is who to mitigate, even in hours where we'll call them net pivotal suppliers are still net pivotal. And they're different, again, different options for doing this, but the general idea is there's going to be some big firms that are pivotal. There's going to be some small firms that are not pivotal. And is it worth it to mitigate the small guys, given, again, our ability to know what the costs of small batteries and other types of resources are is just, we're less confident in that than, say, if it was a gas plant where we had a really liquid gas market. So what are different options here? My understanding from talking, with people who know this better, is that a place like PJM, in addition to testing just the first, second, and third for a pivotal supplier kind of joint pivotal test, would then look at first, second, and fourth. So if first, second, and fourth pass, because fourth, when I'm talking about ranking here, first is the biggest, second is the second biggest, third biggest, and so forth. If first, second, and fourth are not jointly pivotal, then that sort of says, we don't really have to worry about 4 on down in terms of their ability to control the market. My sense is even that might be conservative, in the sense that if we had mitigated firms 1, 2, and 3, essentially requiring their bids be in there at their DEBs, and we think their DEBs are competitive, we can have that discussion. Then basically they can't withhold their generation anymore, 1, 2, and 3. And so really the test, might be, well, are 4, 5, and 6 then going to be jointly pivotal under the assumption that 1, 2, and 3 are already mitigated and are essentially can't withhold from their market. That would be another version of this. Again, we can have discussions. But I do think, again, that if the cost of mitigation is going up, then thinking about, is it really worth mitigating small firms in these circumstances is a discussion we should be having. And when we think about the EIM markets, I think something like the first, second, and fourth test, one of the things I worry about is it's probably going to be, one's going to be really big, and then 2 on down is probably going to be pretty small. And so really the question is, if the one large supplier is in fact mitigated, how much can the other guys do in circumstances like that? And I think that's it. Next slide is, I believe, just for some bonus stuff. I got some pictures of other markets, but I don't need to get into that now. So we'll go on to, I guess we can have a discussion before we go on to Scott's slides.
Jim, thanks very much. Great overview. Ryan, let's see if there's anybody who'd like to ask a question or make an observation. Ryan, is there anybody queued up?
Sorry, I was on double mute. We do not have hands raised at this time.
All right. Stunned silence.
You just did it so thoroughly, Jim, and convincingly. There's nothing more to be said. So
I think that's a good discussion, Jim. It raises these issues that I think feeds back to, the examples this morning when we get all these failures in California, and it's probably due to assuming that some regulated firms in California are withholding a lot of output, and that's not really going to be allowed. And that doesn't benefit because they can't raise the retail price above cost based on their the wholesale price.
Yeah, and I guess I forgot to add, there's a legitimate debate to be had about maybe some firms in the spot market might be thinking about trying to raise forward prices on their contracts if we're talking about a fully deregulated, retail environment. But that's not generally what we're talking about in the Western US, where most of these retail commitments are based upon some form of cost of service and not based upon expectations of what future contract prices would be.
Right. And also, even if they have some kind of wholesale contract, if it's a long-term contract, then you're not going to mess around this year based on supply that comes up for renew in 8 years.
Yeah, and in general, the supply landscape 5-10 years from now, we think of is going to be very different and certainly much more contestable than, procurement 10 years from now is much more contestable than procurement tomorrow.
It's not to be affected much by expectations. Expectations aren't to be influenced by what happened 8 years ago, That's what I think,
Yeah. Okay, so we can move on to Scott's.
And this discussion also builds on Jim and the CAISO's earlier discussion. If we're going to have these tests expanded to the WEAM, it's going to fail lots of people all the time, hundreds of hours during the summer months, because there are hundreds of intervals and sometimes hundreds of hours because of these spurious results. You have to say, are all our DEBs wonderfully accurate? And I think there are issues, what works in California doesn't necessarily work outside California. I'm going to talk about some of those differences. Go to the next slide. And this is just, what I'm going to talk about generally. And the fourth bullet was a typo. I got confused on which presentation I was working on. So go to the next slide. So over the last decade, we've been talking about this a lot, market power mitigation and all the issues that arise for gas-fired generation. But I think we have to focus a little more than we have on how conditions in the Western EIM are different from they are in the CAISO. And one thing that's different is we've got gas-fired generation that's not located right on top of the gas trading point. They're remote from it. So when the gas system is constrained, the cost of purchasing gas delivered to where that generation is can be a lot different from the price at some gas trading hub. Go to the next slide. And the CAISO rules here allow BAAs to associate themselves with more than one gas trading hub. So they may have pipelines that come from different sources and flow in, or one pipeline that you can buy power at different locations and flows in different directions. And we say we're going to purchase gas based on the price at the lowest gas trading hub. Now that makes sense if you can choose and just buy from whichever one has the lowest price. But if it may be that the price is different at those trading hubs. Why? Because of transmission constraints, that you can't actually get the gas from one hub to the other. In that case, yes, it would be nice to buy, it makes sense to buy at the lower price trading hub, but not if you can't. Go to the next slide. So here's a system of a constrained gas pipeline system. And we got a 240 price at gas hub A, and then somewhere down along the pipe, we've got gas gen yellow, and then we've got a gas hub B with a price of 450. Now, the fact that we got a price of 240 at one place and 450 at another suggests that this gas pipeline is constrained, that you can't get the gas from one place to the other, or the price difference wouldn't be so big. Now, if the constraint is between gas gen yellow and gas hub B, and it can buy gas at 240, then fine. The DEB and using the lower price just works fine. Go to the next slide. The problem is, suppose that the reason we got the difference in prices is that there's a constraint between gas hub A and gas gen yellow. And therefore, yeah, it can buy gas at gas hub A, but what can it do with it? It can't schedule it on the pipeline to get to its generation, so it can't burn it. So yeah, you can buy at 240, but you can't do anything to fuel your generator with that gas. And it may be you have then in that situation, you have to buy the 450 gas at gas hub B that's flowing backwards, or it's backhaul or whatever, and you can fire that gas in your generation and run on it, but you can't use the 240 gas. So in that case, the default energy bid based on the gas hub A price could be materially inaccurate. Go to the next slide. Now you could say, well, this doesn't matter because it's only going to happen in extreme circumstances when there's transmission congestion. I mean, on the electric system, there's congestion, and therefore this BAA separates from the rest of the West. But there are a couple problems that we have to think about. One is what Jim talked about and what the CAISO talked about, Quinn and Scott this morning. I guess he should be California Scott. I'm Boston Scott. We'll have to do something about that. But, the problem is if you're mitigating all the time, then these errors in price calculation matter a lot. So it's linked to this question of how often are we mitigating? And also we've got the commitment cost issue. We're mitigating commitment costs in the WEAM all the time. There's no test. It's 8,760 hours a year, we're mitigating the commitment costs. So every time we get the price wrong, the commitment costs are wrong. Now the CAISO has said in the issue paper and other places that they'd allow people to recover it through, after the fact processes, but in talking with the CAISO, they're talking about a FERC filing, which is expensive. I mean, how many hundreds of thousands of dollars do you have to lose before it's worth it making a contested FERC filing? This is not a low-cost process for recovering gas costs. Go to the next slide. Well, maybe I should stop before I'm going to transition to some specific issues. So let's stop and take questions if anybody has comments or stones or questions or whatever. Ryan, is there anybody out there?
We currently do not have any hands raised.
Okay, good. Now I'm going to switch to, how good are we doing and measures of this? And the CAISO issue paper did some discussion of, measures of how accurate things are. But one of the best and most complete figures, which had data for several years, was figure 3, but that was from, 2016 to 2018 and it referred to a California hub. So yeah, that's great, but it's not relevant to the Western EIM, and it was a long time ago. So for the more recent paper, issue paper in the more recent period, I counted there were 23 days at 3 Western EIM gas hubs at which we compiled some data on dispersion. And when I look at that, eyeballing it, it looks like on some of those days, the spread in prices was pretty large relative to the index, but the CAISO didn't really show, clearly how many of the transactions were outside the 10% and how much were outside the 25% and other ranges, but it looks like there are days where there were plenty of transactions outside that range. And maybe my eyeballing it was wrong, but then we ought to have figures like we did for the earlier period where you can see exactly how many of the prices are systematically off. Go to the next slide. The other thing that as we go towards EDAM, all of this related to the price dispersion of trading hubs during the day-ahead timely gas trading cycle. And for EDAM, really, we should be looking at how good is our index relative to the afternoon trading for the evening cycle, because incremental schedules they get in the day-ahead market, that's when they're going to have to buy gas. So today, an EDAM entity can look at their load forecast and think about how they're going to schedule generation and buy gas in the morning cycle for what they expect to need. But under EDAM, they're potentially going to get a schedule for additional gas or less need for gas coming out of the EDAM market. And that's going to produce greater efficiencies. But that's going to require them to buy gas later in the day, because they may be able to anticipate the schedule for meeting their load with their generation and the imports they've scheduled and the exports they've scheduled, but they don't know what's going to come out of EDAM. And EDAM's going to do this optimization, and they may be burning gas to serve load somewhere else. That's the whole idea, that we're going to do a better unit commitment across the West, and that means that it's not just going to be based on what's happening in your balancing area. So I think we need to start looking at how good is our mitigation work for that afternoon cycle when they have to buy more gas to achieve the benefit of serving the broader market. And also and taking account the reasonableness threshold, look at the DEB and the reasonableness threshold and say, how much of the time are we within that range so that our current mechanisms work? And then for the Western EIM, daily markets, the entities can buy gas for the amount of generation they've got, but if they expect to meet their load, but if they're going to get dispatched up more, and if they offer more supply into the Western EIM beyond what they need to meet their load, which is what's relevant when they get dispatched up above their base schedule, because they're not selling at WEAM prices unless they get dispatched above their base schedule. So we're talking about the gas they have to buy above what's needed for their base schedule to meet their WEAM dispatch. So that's potentially the intrastate, the intraday market. So how good are our measures and how good is our reasonableness threshold relative to real-time gas purchase cost? And get that we don't have access to all that data, but we can look at the transaction data on ICE and see how good are we, how bad are we. Go to the next slide. And the CAISO, noted this, that prices during these intraday trading cycles typically carry premiums relative to the standard next day gas price index. Well, and it's not liquid. Well, that tells me that, we need to look at that, that's a cost. And we need to reflect that in our DEBs, or need to reflect it in setting our reasonableness thresholds. Had some empirical analysis of what is the range of variation here that the reasonableness threshold has to cover, which doesn't seem to be in the issue paper or other places. Go ahead, another slide. Going back to the issue I talked about before, all of the data relates to price dispersion at gas hubs. But it's also relevant to say how good are our index prices that we calculate for the hubs relative to the actual cost of gas to the generator, including the fact that he can't buy the 240 gas, he has to buy the 450 gas because of pipeline constraints. Now, I know this involves resource-specific data and it's harder to do, but I think it's part of the burden, if we're going to run this market, that we need to see how good our metrics are. How good are our default energy bids in terms of what's really happening in the market? Go to the next slide. The other thing that market, a number of WEEM entities have talked about in many comments over the past few years is that there's a difference driven by gas storage between the CAISO and the Western EIM. In terms of the CAISO is blessed almost singularly in the country with a bunch of consumer consumption area gas storage. And that gives the CAISO and the gas generators in the CAISO a great deal more flexibility in scheduling gas than in other regions of the country, because gas purchases interstate pipelines typically flow for the remainder of the day, not just for the 4 hours you get a schedule. Now that's great for the CAISO because you can balance that and flow some in, and SoCalGas will put it in storage and it comes in and out and you're set over the day and they take care of that. But if you don't have storage in the consumption area, what are you going to do? It's pretty expensive to buy gas to run for 4 hours if you have to buy it for 16 hours or 24 hours. So one way to recover that cost and factor in the risk of, putting it back in the pipeline and it's worth half that the next day or the next week or whenever they let you take it out, or maybe they make you burn it, is to run some of that risk in your startup cost. But, that's because that's subject to mitigation. And I understand that it's going to be really hard to calculate a DEB that reflects those costs, but that rolls back to what Jim was talking about. If it's really complicated and hard to get the costs right for WEEM entities, we shouldn't be mitigating all the time, even when there's no problem with competition, which goes to commitment costs, and it goes to anything of these new tests we're going to do for broader areas. They have to be done right. We can't just be rounding up the usual suspects and shooting them. I'm switching gears now, so let me pause here in the rant and see if anybody has comments or questions. Ryan?
We do have a hand raised from Daniel Johnson, if you want to go ahead.
Danny, go ahead.
No, I agree with what you said, Scott, and that's what we're trying to look at in the Gas Resource Management Initiative. The next day problem is hard. One of our ideas is to try to use a much more accurate D2 with better forecasts, better bid data to try to get a ballpark for what the next day gas procurement might be if you're a BAA and you'd be exporting out beyond what your need for load is. The other part, which we agree with,
but I think that's going to be really hard to get a 2-day ahead forecast. So we need to have a backup plan, and I haven't seen any analysis yet that we can do a decent forecast. Go ahead.
Fair enough, but it's a non-trivial problem, but there's a little bit of an incentive. Like the biggest gap on getting a good forecast is getting good market participant information and then running the optimization. But to the extent that there's now an incentive to offer kind of make reasonable offers into the market to figure out where you'd be positioned, maybe there's a little bit of a chance for improvement on D2 accuracy, because the EDAM BAAs want to know what their gas schedule could be, so they have an incentive to more robustly participate.
Right,
and
then it's still a matter of they may not know, they may not be able to forecast 2 days out what their, they may be just error in the system that we don't have, no one has good enough foresight. So that's a possibility. It's great for you guys to do that analysis. It's good, but I think we have to see how good it can be and have a backup plan if it's not very good.
And I think that we would plan in the next iteration of that proposal to put out some of that analysis to at least get what the existing variation is between D2, D1, and then D2 in real time from a gas burn perspective.
That'd be great.
And then the other part about volatility, I think we again agree, but when we did a cursory look, we didn't see a huge correlation towards what underlying drivers were driving that volatility that would necessitate kind of higher bounds within the automated RLCL process. And so
I'm sorry,
we're open to.
There were statements like that in the paper, but I could not figure out what they were based on. They seem to be just assertions. So what do you mean? I mean, there were only 23 days analyzed, and some of them seem to have huge variations in gas prices relative to the index.
Oh, no, totally agree. There's huge variations, but across those 23 days, there wasn't like a common driver of this type of event was happening
in this geographic region that would be used as a good forward trigger for when you might want to have a bigger kind of bound on what the deadband for offer adjustments is.
Right, but yeah,
And-
that's true. It
yeah.
might be hard, but the other way of looking at it, which Jim and I have been posing, is since we can't do it right, because we can't figure it out, then we don't want to mitigate people when they don't have market power. So we don't want to mitigate commitment costs all the time, and we don't want to use a test for, global system market power that treats, PG&E as a market power exercising entity. And we don't want to treat supply that's offered in at zero as potentially withheld. So, I mean, the other way of looking at it, Danny, is because that's so hard, we should look harder at not applying mitigation and imposing those when there isn't really any potential for the exercise of market power.
Agree. And our premise would be as accurate as possible with this.
Right.
I don't think we'd want to, like your example earlier about should we be mitigating when you have negative $15 win somewhere, if I'm remembering it right. That's fair. That's a little bit different than should the offer cap be 110% of the index or 120 or 130. I guess to the extent we don't know, then it is a policy question on which side do you lean? Do you give deference to the suppliers with their offers, given how hard it is to actually forward project those to maybe exercise market power? Is that what you're saying?
I'm saying if we can't get the gas price estimates right, and we're doing as good as we can, but if we look and we see they're actually off, then that means it's more costly to have policies that mitigate when there's no market power, which I view the commitment cost mitigation as one of those. And the flaws in the other test that Jim was talking about can trigger mitigation when there is none. And we're, the analysis that Scott and that California Scott and Quinn were putting up this morning was saying, look, we're on the verge of something that would mitigate all the time in the evening hours. And it's based, presumably, we suspect, reading between the tea leaves, it's based on assumed withholding by regulated utilities and serving their own load. And so maybe we should, given that we can't get the gas costs perfect, maybe that we have to look more carefully at, do we really need to mitigate in these hours? Before we jump off that boat and say, sometimes we're jumping off that cliff saying, oh, there's no harm to over mitigating because we got the gas costs right. But maybe we ought to check and say, no, we don't have the gas costs right, and we can't figure out how to do it any better. So we got to worry more about triggering mitigation when there's no potential at all for the exercise of market power.
And I don't think we're disagreeing with that at all. Where we are in this process is just trying to figure out how well are we capturing the gas prices. And as you move to like the broader footprint, are our proxies and our processes reasonable still?
Well, I think, that's what I'm suggesting. A lot of the things I said, we're suggesting how we could look more accurately at how good we are.
Okay, yeah, I think we're in alignment. And then the one last point, when you say mitigating commitment costs, are you referring to the cap on commitment costs roughly?
Right.
And anything beyond that being a mitigation?
Is CCW. Yeah, that's the next slide.
Okay.
So go to the next slide. Oh, wait, Ryan, is there anybody else on the line?
Yes, we do have a hand raised from Lindsay. Lindsay, go ahead.
Hi, Lindsay Schleckway with NV Energy. I don't have a whole lot to comment on here. I just wanted to say thank you, Scott, for putting this out. I completely agree with what you're saying here, and I agree with the approach that you've laid out on how to look at it. We definitely do support the D+2 that CAISO has put out there, but we think more needs to occur than just that, and you'll see that reflected in our comments. But I just wanted to say thank you.
Great. Ryan, is there anybody else?
It looks like that is it.
Okay. So the last topic, we can get off to lunch in just a couple minutes here, just a couple slides. So this has turned into the commitment costs in CCW. And, you know, we went through this and sweated blood and for months and maybe a year or so on changes to commitment costs. And the CAISO talked about in the issue paper why they decided not to implement it. And they mentioned concerns that DMM had with various elements of design. But the thing that struck me is that CAISO didn't talk about ways to address those concerns so that we could get away from mitigating all the time, whether or not there's market power. And that feeds back to what we've been talking about, that there, you know, we need to look at carefully at how well we are doing in the Western EIM and not just assume we're doing great because it's different from the CAISO. Now, the first thing is DMM had a concern with a one-time increase in the bid cap by a huge amount, but we don't have to do that. It would be easy to stage it and increase it, and, you know, but now it's been 6 years and we haven't increased it at all. So we could have had a nice transition for over those 6 years of raising it a little bit once a year, and we'd know whether we had a problem or not, or maybe we'd have a much different bid cap. There was also a concern of mitigation of resources committed out of market or exceptionally dispatched by the ISO. And, you know, I've worked with a lot of ISOs, and every one has rules for, you know, resources committed out of merit by the operators. And I gave a bunch of lists for the tariffs of where you can find those rules. So that's not an insuperable burden. Everybody else has figured out how to do it. Go to the next slide. Another is a concern with raising their offers after being committed and stuck. And stuck is a longer look ahead than some other ISOs. So there's more potential for raising offer prices, but that is something you can do. You can restrict offer prices after a long start unit or long minimum runtime resources committed in stuck so that they can't do that. And the ISO went live with their LMP market yesterday, and they have a 24-hour look ahead tool in eRook, and they have rules restricting. So it's a very long look ahead, and they have that kind of rule. So it isn't the end of the world to do that. There's also concerns with maybe that the CAISO was not planning to mitigate units that are not committed. Well, to get this off square one, mitigate the units that aren't committed too, if there's a potential market power, and if there's any possibility they could have exercised it. But we're in this world where we're mitigating these resources every day. We're making them use a gas cost that might not be right, and it's probably not right on the days where it's expensive. Go ahead to the next slide. I'm almost done here. So my view is, you know, if we can go back and show that we're getting the gas prices right almost all the time, fine, then we don't have to worry about this. But I don't think we can. And then we should start. So that's why we should care about the issues Jim talked about and the issues I was talking about gas costs, because we don't get the price. We can't get the prices right all the time. So we need to think about CCW, and we got to think about the rules for mitigating system market power and other things that Jim talked about. And even the local market power in the CAISO, because if we're doing it based on, economic withholding by PG&E, we're triggering mitigation when there's no real market power. So that's it. Let's stop and take questions, Ryan, and then everybody can eat lunch.
All right, so we do have a hand raised from Adam. Adam, go ahead.
Yep. Hi, this is Adam Swather from DMM. Scott, I wanted to follow up on something that you've referenced a couple of times here related to this issue of flagging market power by regulated utilities that may not have incentive to exercise market power. So I think this assumption that regulated utilities have a different set of incentives related to market power, it seems accurate, but we haven't directly, or I guess that hasn't directly informed market power mitigation design in the past, right? We've kind of proxied for this, given that historically in California, these have been net buyers. So PG&E is the one that's come up. PG&E has historically been a net buyer, and its treatment in the RSI calculation, I think kind of addresses this problem that you've raised today. So I guess my question for you and maybe all of the MSC is, what are your thoughts on incorporating considerations of outside regulation and the associated incentives of that into the design of wholesale market NPM? It just seems like there can be challenges with that, especially differences in regulation and, how you would come up with a way to do that systematically across different states, different entities, et cetera.
It seems to me we can offer a carrot. If we can figure out what we need to know, we can offer a carrot to the utility that if you can show, how much of your retail customers are served on a regulated rate that's unrelated to the spot price that your offer prices. I know in the Midwest that there are regulated utilities that flow spot prices through to their large industrial customers on high price days. But that's because they're buying power at the margin to serve those customers. The regulatory commission would go nuts if they were passing through high costs to the utilities and not running their generation. So I think they're reasonable questions you can pose to the utilities and they can satisfy. So if they want to pass this test and not get mitigated and I thought my understanding is that the reason we're constantly failing LMPM is that some of those California utilities are not net sellers under the test. You assume they're not sellers in some of your offline analysis, but then in the test that applies mitigation, I understand they are net sellers. So even if they're a 100 megawatt net seller, we assume all of their supply is withheld.
Okay, so I guess on the more general question though, you don't see any issue with potentially, again, I guess the distinction I'm drawing in my mind is historically in designing market power mitigation, you're sort of focused on incentives that exist within the market, right? Within the wholesale market, within the CAISO market. We're talking about, I think, a sort of regime shift where we're now saying, okay, we don't think these entities that, are large and regulated entities actually have incentives. So now we need to take that into consideration. I guess you don't have any concerns or would see any challenges with doing that?
Yeah, I think we need to, if we're going to use the 3 pivotal supplier test, and if we're going to assume that people are going to withhold all their capacity from the market, then we have to have a reality check of can they, if they have PG&E is 20,000 megawatts of retail load, can it really withhold 25,000 megawatts of supply from the market? It can't. Now, in other regions where a lot of vertically integrated utilities like MISO and SPP, they use a conduct and impact test. And so it's a little bit different and you don't have this issue. But the CAISO uses the 3 pivotal supplier test and they make the assumption that the regulated utilities are going to withhold all the supply, even the supply that's needed to meet their retail load. Now, we're not saying that you shouldn't assume they withhold some of their supply if they're net long, but if they need 80% of that output to meet their retail load obligations, we shouldn't assume that they can withhold all that. And even we could be conservative. We could just say, well, they can't withhold, that 20%, they can only withhold 20% of what we think their retail sales obligation is. That would probably still radically change things.
Yeah, I just want to highlight the fact that there's a distinction here about assuming that regulated utilities behave like perfect competitors for their entire supply portfolio, and that their retail obligation is a completely different non-market consideration. So what we're talking about here is just the retail load that is, I think in vast majority of these cases, under some kind of cost of service treatment, and not assuming that the rest of their generation is being offered competitively.
Yep. Okay. No, that's a fair point taken there. Thanks, Scott and Jim. Appreciate the discussion.
We're glad to talk with you. Is there anybody else?
Thanks
for Ryan.
It looks like he was only hand raised.
Okay. Ben?
So, Adam, thanks very much for stimulating the great conversation. Appreciate everybody's involvement this morning. It is now approximately 1:15. And so I'm going to suggest that we take a lunch break until 1:15, if that's okay with everybody. and then we'll resume with the EDAM item on our agenda. So Ryan, you can put up the sign that says that we're taking a lunch break now, and we'll see everybody in about 35 minutes.
All right, welcome back, folks. If you were here for the undercard of Market Power Mitigation in the morning, you've made it through to the main event. We're going to talk about congestion revenue allocation and EDAM. And the first presentation is from James Lynn of the CAISO. Take it away, James.
Thank you, Jim. I appreciate that. My name is James Lynn. I'm a principal for market settlement design at the ISO. Joining me for support is George Angelides, executive principal for Power Systems. We may have additional answers that he can provide. Ryan, if you can move to the next slide. Today, the initiative we're talking about is the EDAM congestion revenue allocation. This initiative is focusing on overall congestion revenue allocation, but more specifically on the congestion revenue rents arising as a result of parallel flows of flow-based constraints in schedules from one BA and another BA. Basically, we're trying to decide how those revenues should be distributed by the market operator. As we know, congestion revenue allocated by the market operator affects the amount of congestion revenue that an EDAM BAA, and particularly EDAM entity, can sub-allocate under the terms of their OAT or tariff. This initiative discusses the current approved EDAM congestion revenue distribution, as well as the potential transitional alternative approach that is being outlined in the draft final proposal. I will briefly touch a little bit about the issue paper, but not going to discuss that approach. This initiative does not seek to address or modify any of the allocations associated with congestion related to transfer revenues. The transfer revenue distribution is expected to change regardless of this initiative. If we can move to the next slide. Under the current FERC-approved design, congestion revenue is allocated to the BAA where the internal constraint is located. We're collecting it through the settlement of the schedules at the LMP, and then based upon that schedule's contribution to a constraint, that determines how much of that congestion settled with that resource is going to be included in the distribution to the BAs where the constraint resides. This process or this methodology is consistent with what we do in WEIM today. So we carried it forward from WEIM to EDAM as part of the EDAM framework. The EDAM Balancing Authority areas then has the discretion to establish how this congestion revenue is being sub-allocated within its OAT, whether it's to the transmission customer, to measure demand, it's up to the EDAM entity to make that determination. However, recently, PacifiCorp and Portland General Electric proposed OAT revisions which seek to provide a level of congestion hedge to its transmission customers which exercise its monthly and long-term OAT rights. And because of this filing, that is why we have expedited this initiative, is try to help facilitate the ability for them to provide the hedge. If we can go to the next slide. So as I said, I'm going to touch on the issue paper a little bit. In the issue paper, we establish a transitional measure that based upon that transitional measure, we receive specific 4 areas of input. One is defining a transitional to a long-term design. How long is the transitional measure going to be in place before we establish a long-term design, as well as how are we going to continue an engagement in the discussion on congestion revenue? The second one is the allocation of congestion revenue beyond the exercise of OAT rights. The concerns was that the initial measure was over allocating the parallel flows of congestion revenue, and that we needed to review that. The third point that came up is we had a specific example that was pointing out the issue of counterflow. So there was concern on counterflow congestion allocation, and that the BA where the resources that were economically dispatched to resolve the congestion, that BA was paying for that congestion instead of the load that it was serving. And then lastly, it was the self-schedule incentives of relying on self-scheduling of your OAT rights in order to get this hedge. These four elements fed into the overall proposal for the draft final proposal. Now, if we can go to the next slide. So in the draft final proposal, we decided to narrow the focus on parallel flow even further. Instead of doing overall parallel flow, we're focusing on parallel flow congestion revenue is being allocated to the balancing authority area where an firm OAT right exercises right, so it's the BA where that OAT right was exercised. Now, this includes long-term and monthly firm point-to-point contracts or transmission rights, as well as network integration transmission service rights. The allocation would be consistent with the OAT terms and conditions of both the point-to-point and NITs. The key element of it is the ability for them to exercise their rights, and using the exercising of their rights through balanced source sync self-schedules, we're able to identify exactly what the congestion exposure of those self-schedules are, and be able to address how we deal with parallel flow as well as internal flow congestion. Any remaining parallel flow congestion is going to fall under the current FERC-approved allocation methodology, which means it's going back to the balancing authority area where the transmission constraint is located. If we go to the next slide. So what are the key areas of the proposal? One, the design introduces a more target and refined allocation of parallel flow revenues. The reason why we focus on parallel flows is the FERC-approved tariff language for congestion allocation already accounts for internal congestion revenue allocation. So if I'm a schedule in a BAA and I'm exposed to internal congestion, that internal congestion is already being allocated back to that BAA per the FERC-approved methodology. Now we're looking to see how do we handle parallel flow. This draft final proposal allocates parallel flow congestion revenues to the EDAM balancing authority area where the congestion is collected and paid to support the ability for the EDAM entity to provide the congestion hedge protection for these transmission customers. As I stated earlier, any remaining parallel flow or any other internal congestion revenue of another balancing authority area is being allocated to the BAA where the constraint is located. This is the FERC-approved method. Now, one of the things it also does is addresses concerns related to balancing authority areas being exposed to congestion costs, regardless of providing parallel or counterflow effects in relationship to the constraint. And this is because the parallel flow treatment is going to be an equivalent treatment regarding whether it's a counterflow or a parallel or prevailing flow congestion. And I'm going to open up here. I've gone through a couple of slides real quickly. Do I have any questions here?
Oh yeah, go ahead.
I just want to make sure I understand this counterflow because I seem to get confused on it every time I hear it. So if I have a counterflow transaction and it's a intertie transaction, so I need to self-schedule it essentially. It says it's allocated, the congestion revenues are allocated to the EDM area where the constraint is located. Now, they're negative because it's a negative, so they're charged. Is that what this is saying? They're charged, and it goes to because I thought when you were saying last night, you were saying it was the entity that was self-scheduled gave up the counterflow payment.
So let's, I'm going to distinguish a little bit here, Scott. In the intertie schedule, if it's self-scheduled using its rights, so they've indicated using their CRN, what they were charged at the intertie schedule, that congestion is going to be included in the hedge that we're going to provide the entity in order to pay back that intertie transaction for scheduling that energy.
Wait, just a second. Let's go slower here.
Yep.
If it's a counterflow, I'm putting in power at a price where it's 20 and taking it out at a place where it's 10. So the congestion charge is negative, and therefore I'm basically, normally I'd get paid for that counterflow because I'd put it in, I get paid for 20 for taking it in, putting it in, and charge 10 for when I took it out. So I'd actually get paid for the transaction.
Okay, so when you use negative, I was applying the negative to the import side of that schedule. I see what you're saying. So this is a wheel through, and okay, so under a wheel through transaction, if they are scheduling their rights, then you are correct. That $10 I'm going to include with the EDM entity so that they can provide you with a hedge on that congestion. What that hedge means for that schedule is that it would be a charge back to that transaction to reduce their congestion exposure for the entire transaction.
Well, they would not reduce their congestion exposure, but it would reduce their congestion, the revenue. They're not exposed to congestion. They're getting paid, so they'd get paid less for counterflow, right?
Correct. And I use the term congestion exposure as it could be a positive or negative thing to you.
Okay.
Yeah, perfect hedge means you don't pay anything, you don't get paid.
Right. And one other thing, so you said putting in the CRN number. Now, does that mean, can they schedule a point-to-point firm transmission right and self-schedule it and not put in this number? Or do they have to put in that number in order to, schedule the transaction?
Correct. So that's the second phase of the answer to your question, was if this was a wheel through and they're not associating the contract reference number, settlement sees them as a market mechanism. And so therefore, they're not included in the hedge that I'm providing to the entity. So in that scenario, they would be able to keep the $10 because they're indicating that they do not want to have their congestion exposure reduced.
Okay. So people can basically just, when they're creating prevailing flow, they put in the number, and when they're creating counterflow, they'd just not put in the number. It'd still be a self-scheduled intertie transaction, and they'd keep the money.
They can, yes, they can, from hour to hour, they can exercise their rights in a similar manner as a TOR ETC.
And just to complete this, then, so let's say they are just scheduling it like a wheel through, and so they do just keep the profitable congestion exposure for this transaction. The money to pay for that would come then from the BAA that had the congestion that's being relieved by this schedule, right? And instead of the one where it's actually being sort of implemented into.
Yeah, more likely we're collecting the congestion through another demand settlement. And since this isn't a transaction that is exercising the rights using the contract reference number, this congestion will go to the BAA where the constraint's binding, and it should be offset by any other economically dispatched congestion.
Right, I agree with that. The counterflow should enable more economic transmission to be scheduled, so the balancing area should collect that additional money.
And so we'll collect it, we'll put it to the BA where the constraint's binding, and then this will go also in there to offset it. So the net of these two is in essence what the congestion cost at that constraint is.
Another question about exercising the NIT's rights. That would apply to the rights of the balancing area operator as well, not just people that bought it from the balancing area operator, but the balancing area operator's own network transmission service to serve its load. It would also be eligible for this?
That's our anticipation, is that they should be able to establish the contract reference number, and how they would establish it is they would identify the set of resources that are going to serve that load, and they would set the contract reference number between those resources and that load. And then when the market runs, whichever resource is expected to serve that load would schedule using that contract reference number.
Right, and
The load will,
they'd self-schedule
correct.
using, yeah, okay.
Correct.
All right, so it does seem like we do have a hand raised from Abram Klein. Abram Klein, go ahead.
Thanks. It's Abram Klein with Appian Way Energy Partners. Thanks, James. I think I understand about OAT rights being made whole if they have flows on a parallel BAA. What hasn't been clear to me in this process, and I wonder if you can clarify for market participants, is what happens when a CAISO firm transmission right, such as a CRR, has a parallel flow on an external BAA's constraint. So like currently, I would think that, you know, if there's CRR within California and it happens to have some loop flow into an external entity, there's no, California is collecting all the congestion rents associated with that. And it doesn't see congestion externally because we don't have that kind of market design. But now we're overlapping this broader congestion-based approach overall. And I'm wondering what happens when those CRRs are flowing on a constraint externally. And suppose there are OAT rights that maybe are not using all of that constraint. Are you using the existing constraint allocation, or is there some mechanism to ensure that the CRR is made whole?
Okay, so the CRR and CR1B mechanism is not being modified or changed as part of this initiative. But in order to provide more clarity, we're going to need to, one, go into more detail with CR holders and ISO BAA, but I'll give you a high-level answer here. Is in CR1B, our tariff language says that CRRs are going to be funded by all the constraints that impact that CRR, and is the revenue from that is coming from the ISO schedule's contribution on those constraints. So what that means is that under the current proposal for EDAM itself, the framework, is that CR1B will look at all of the constraints, both the constraints inside of the ISO balancing authority area, as well as the constraints outside of our balancing authority area. It will look at how the ISO schedules impact those constraints, because that is what the ISO schedules congestion exposure is. And so we're creating the ability for the CRR to hedge against those schedules. And so that's how CRR revenues or congestion revenues are used to determine the CRR 1B payment to the CRR holders. Now, that
James, I have a question. But we're not gonna, since we're not self-scheduling, you know, point to point or NIT service, we wouldn't be entitled to any rebate on those flows on other people's constraints. So we'd be paying it, our transactions would be paying it, but we wouldn't collect the congestion rents. And I think that's what Abram has in mind.
And I think that's where in this other initiative, another meeting that we have to do is we have to discuss that further. Because that's more of a EDAM design possible change versus this initiative. But to further go into it though, is once I get what the CRR holders should be paid, settlement system will get it, and we will do the appropriate CR1B CRR payment. Now, when it comes to offsetting that payment, I now need to look at my overall schedule's settlement from congestion. Now, this will take all of my energy schedules as well as EDAM energy schedules, particularly those that are not associated with OAT rights. And if they have a contribution to a constraint in the ISO, that congestion revenue comes over to our balancing authority area.
Right.
In balance reserve, we will have the same thing. Sorry, Scott, go ahead.
But I mean, I think Abram and I are talking about when the constraint is in someone else's balancing area. I think we understand how it works when the constraint is inside the CAISO. We're just going to have to carve out. We already do carve out for you know, parallel flows. But here it seems we're concerned about. It looks like this is not this design is not symmetric because CAISO transactions aren't going to be self-scheduled, and other people's intertie transactions that affect the CAISO are going to be self-scheduled or can be self-scheduled. So there's you know, I don't know, you know, like
asymmetry.
Anything that flows between SCE and PG&E, maybe that's going to have loop flow. Maybe this stuff never binds. I don't know. I'm speaking in a complete factual vacuum, but
yeah, and I think when these things, where the two initiatives or the two considerations do kind of overlap is, and maybe we'll talk about this, is with this policy, it seems like if you have a new BAA that's joined EDAM and they're considering whether to adopt a CRR model and market and sell CRRs or continue to sell firm transmission rights. If they sell firm transmission rights, they get this transitional, you know, they get them funded. But if they sell CRRs, the concern would be, well, then they don't get this sort of rebate of the congestion that's impacting other BAAs, and that creates a concern there.
James, can I just follow up, because I wasn't clear actually from what you said. It sounded like California, when it's implementing EDAM, is going to look at the actual flows in the hour in the day-ahead market of California entities. So if there were flows from Southern California to Northern California, and they were going on an external balancing area that had a congestion, would the congestion rents associated with that go back to California or not go back to California?
So that's why I didn't get to finish the overall.
Right. No, I thought I saw.
I understand. I understand your question. From a CRR 1B determination on payments to the CRR, it is considered when making the determination on what a CR holder should be paid. What Scott, and I think you have also identified, is that when I basically settle all the energy and I apply the FERC-approved methodology, I'm only considering the ISO constraints, the congestion from that. So there is a potential disconnect between what we are paying CR holders and what we are using to offset that payment. Part of that, I think that will help reduce that is the fact we also have imbalance reserve and any ancillary service congestion.
Well, yeah, but it is exactly an issue of comparable treatment as Dr. Harvey and Dr. Bushnell identified. I mean, I think Steve Keen has raised the issue of like trying to identify firm flow entitlements or things like that between regions. I mean, I do think there needs to be some accommodation in EDAM such that if there's congestion in an external balancing area that California has some parallel flows on, and there are not OAT rights that are taking up with those rights should go back to be able to fund the California CRRs and not just left there as residual money for the external BAA to distribute, because you're basically saying for the firm rights in California, the external entity is going to have a claim on those for their firm rights. But if a constraint is external to California, the California entities don't have a claim on those rights.
I hear you, and I believe that is an open topic for how CRRs are settled within California. I understand how it interplays with this. The difference to me is the OAT right treatment to me here is treating it more like an ETC. They're long-term monthly rights holders that have the ability to schedule their transmission. And if these were established as a TOR or an ETC, that exact same type of mechanism would go into place. What the EDAM BAAs is in their OAT are declaring that these are very similar to ETCs or converting rights, and that they should be receiving the ETC treatment.
Sure, and the ETCs are it's kind of a small subset of what happens in California, but most of the California Network Integrated Transmission Service, the firm rights associated with, the utilities meeting their loads, is with the transmission network that they have paid for, is converted into allocated CRRs, which is effectively, and FERC has ruled, is essentially firm transmission and should be treated the same way. And I think the concern is that you want to have a mechanism in EDAM where the network integrated transmission service of all the entities are treated comparably.
So, and I want to be clear, is under the current proposed implementation of EDAM for CRRs, the CRR holders are getting equal treatment. The difference is pulling in the additional congestion revenue associated with parallel flows to offset what you have said CRR holders should get paid. So if I have a CRR in the ISO going from point A to point B, the congestion difference is $10. $6 of that is ISO constraints. $4 is Pacific Core constraints or another BA's constraint. CRR holders under our current proposed design will get the hedge for the full $10. However,
I don't understand that, James. How could they? Because we got the proration in effect. If we don't collect, are you saying the proration will not be applied?
So that's yes and no. So CR1B will give them the hedge for full $10. What I collect in my overall energy settlement will be $6. Both of those will meet in the balancing account. And so it's that extra $4 is what is the discrepancy here, but that also could be offset by any PacifiCorp or EDAM BAA's economic dispatches congestion revenue.
I don't understand it. I don't understand. Why would we get their congestion revenue?
So if their congestion,
if their non-OAT dispatch creates flows on California, we'll get some of that revenue.
Right, but that's for the cost on our constraint.
Yeah.
Yeah, but this is that we're going to get that part, but we're talking about the part where we create congestion on theirs.
Understand?
We don't get anything.
We don't get that.
Yeah.
You're
And
correct.
then-
You get, Scott, you get fully funded at 60%.
Well, it sounds like the rights holders get funded, but well, this is where the haircut policy.
I think he's saying that they have a claim on the funding of 100%, but there's not money to collect it, so it gets ratioed down according to the proration method that California adopted.
So there'll be a revenue inadequacy that'll have to be then clawed back from the rights holders.
Exactly, but I mean, this whole EDAM proposal is about essentially ensuring where the congestion rents go. It's about revenue adequacy, and we're doing this to ensure that the OAT rights of external entities are treated in a certain way that allows them to operate their rights. But you know what I'm contending is that there should be equal treatment between the two. At least there should be some mechanism to evaluate if California is flowing on external constraints where one of those is binding. There should be some ability to also have the rights flow back to California entities associated with, the firm rights within California.
I try a summary to see, tie this together and make sure I understand it. So in the long run, if LMPs are calculating the full network model, and I don't think anybody would suggest suggestions in LMPs to correct this. There are three classes of solutions to this. One is the haircut, the incomplete hedge. You only get 60%. Another one is expanding CRRs to all of EDAM. I'm saying this is long run. And the other possibility is some sort of lump sum transfer, evening up at the end of the year or whatever between the ISOs, and somehow that goes back to CRR holders in some complicated way. Are there any other possible solutions?
Well, Ben, if I could just add, I mean, it may well be the case that there are not OAT rights that are using up 100% of the flow, and California rights may be using up some of it. And I think there's a gap here in the EDAM design, which is saying that, for non-California areas, if they have excess, it just gets left where it is, because there's no sense that the California CRRs have any entitlement when those firm rights are flowing on the external entity constraints. So we've done all this to solve, PacifiCorp's problem, which is fine. I think it's a very good proposal, and you're correct that there is different long-term solutions that are solved for this. But I think in the interim, there needs to be some mechanism of some minimum level of firm flow entitlements or some kind of thing that's looking at how California CRRs, as they do today, may be flowing on external entity constraints. And, you're potentially creating a whole new class of underfunding associated with this EDAM model that wasn't there before.
And where we are is that we don't. This is not an issue that's being addressed in this proposal, and there could be this gap. We don't know how large it is. Whether, as Scott suggests, maybe these are very small, or maybe they're not. Scott, you're going to say something?
It's exactly the same issue, right? It's about how are the firm rights being treated when there's parallel flow on an external entity BAA, and those in the market design, they should be treated comparably.
So if I can interject real quick. So Ben, I liked your synopsis. That is the question. The question is, should, when someone buys a CRR, are they buying a CRR to hedge against California-only constraints, or are they buying a hedge to hedge against the overall market footprint constraints? As I indicated in how the current proposal is in the EDEM implementation, is that CRR holders will get the hedge or the revenue across the footprint. And when it comes to offsetting what I'm paying CR holders, we're only getting that congestion associated with our constraints. So it's how do we align what CR holders are eligible to receive and how much money that I collect from the settling of the awards to offset what CR holders receive. And I think that's why we want to take it to another discussion.
So can I ask, I should know the answer to this, but now we have a full network model when we run our day ahead market. And so are those parallel flows essentially showing up in intra CAISO nodal prices today? If in other words, or are the constraints turned off if it's outside of CAISO?
I think they're turned off, right?
I'm going to let George answer me if I answer this incorrectly, but they are turned off for the most part.
There are flows, but there are no capacity limits.
Okay, so yeah, so
I may be wrong.
our nodal prices today do not capture any parallel flow impacts on other BAs.
Yeah, currently external BAAs are able to have loop flows on California system. They don't pay for the congestion they cause, and likewise, California CRRs or flows have flows on external and constraints, presumably, and they also don't pay for the costs that they cause. But what's happening here is now we're saying, okay, now we're internalizing this and saying that the external entity is actually going to get made whole for the flow that they make on California's system. But now when California is flowing on the external entity CRRs, we're going to leave that in the external BAA rather than have any mechanism for making whole the California firm transmission rights, which in some cases they're CRR holders who purchased, but in many cases they're allocated rights for load serving entities that are trying to serve their load. In fact, in the majority of the cases, that's the case.
I want to go back and something we just said, I don't think is quite right, because although we don't model our flows on the other balancing areas in the IFM, when we get to the WEIM, the other balancing areas have base schedules, which will create flows on the CAISO, and they're hedged on those because we only settled their deviations from their base schedules. So their base schedules can create loop flows on the CAISO for which they don't have to pay.
Right.
If our IFM schedules create loop flows on an IFM entity, we do have to pay because we're not set. We don't have any entitlements on the WEIM system. So today there's actually that, but it doesn't show up in the day ahead market. It shows up in real time so that we can have congestion shortfalls in real time because of money we have to, pay congestion charges on, all depending on how that WEIM money flows.
And with virtual bidding, it might actually show up in the day ahead as well then.
Well, that's an uplift. So it's not maybe it will. I don't know. Yeah. Maybe prices would be higher in the day ahead, would be higher in real time. So they submit. Yeah, maybe you're right, Jim. Yeah.
Well,
you can't necessarily make the constraint bind, but you can, if the constraint not modeled, then you can't make it bind with virtual bidding. But if there's another constraint that is, you can drive that up to close the gap.
Yeah.
So what I was planning on doing is we are going to talk about another initiative, or another review of EDM implementation on CRRs, and we're going to highlight this so that we can address the points that has been raised here, particularly from Ben's summary on what are CRR holders purchasing for, and how does that align with the congestion that's being used to fund CRRs versus the congestion that's used to offset the payments to CRRs. But from a principal perspective, the CRR revenue payment is consistent with what we are doing with OAT, but also that OAT is being consistently treated here as if it's an ETC. That's why we have made in the discussion in the past that this did not impact the CRR mechanism because it does not impact CR1B.
So I guess it's a matter of perspective of whether it does or doesn't.
Mhm.
Yeah.
So I think, you know,
Understood.
Seems like there'll be a revenue difference that needs to be made up somewhere.
Agreed.
Okay, so to ask the question, what could go wrong? How bad could it be if if that gap turns out to, we go ahead and haircut the CRRs. Basically, it would show up it could show up as a much larger revenue adequacy than we have now, and the value of the CRRs for day ahead transactions are degraded. That's the worst that could happen. And how bad could that be? I mean, how bad is that?
So my anticipation is that with the introduction of a wider footprint, the congestion, the binding constraints or the congestion revenue collected should be potentially less. I mean, it's not going, because we are having more energy to manage that congestion across the footprint.
Yes,
certainly. Yeah, also the introduction of imbalance reserve congestion from schedules and energy in EDAM BAAs that have contributions on ISO constraint, having that revenue go in to offset what we're paying CRR holders. I don't really anticipate it to be worse off than today. I would actually anticipate it to be better than today. That's my opinion.
Yeah. So, sorry to dwell on the risk, but it's good to have some idea of what it could be on both sides. And I certainly hope that you're right. And there's a reason why we're doing EDAM is to prove efficiency, and that those gains will more than offset that. But there is a risk that this is getting out of hand, and we'll have to do something quickly to put a tourniquet on it.
And I think that's where the monitoring is going to come in, and we get into a little later on the additional efforts we're going to do to try to come up with a long-term solution. I think that's where those monitoring, those steps need to come in. And if we do see that there is a significant impact, then we can address it as fast as we can.
James, I want to thank you for committing to look at this issue in the context of the CRRs and bringing that back to stakeholders, because I think that this is an issue with respect to how EDAM had the potential or has the potential to impact the firm rights of California transmission customers that has not been sort of very clearly laid out for the market participants previously. I don't think there was a sense. And again, we don't necessarily know how big this issue is. It's just an issue of having comparable treatment between the two. If you're going to treat one set of firm rights and you want to treat the California firm rights at least equivalent with your neighbors, especially as you're expanding the market. That's part of the whole point here. So I think that's an issue that may come as a surprise to some of the California transmission customers, that this would potentially worsen that. So I certainly understand that not everything would be anticipated in advance with this very complicated process of overlaying an LMP ISO system with the OAT system as well, and appreciate what you're trying to do here. But I do think this is an important issue of the comparable treatment of firm rights between different BAAs, and thank you for coming back to market participants about it.
Oh, you're welcome. And I look forward to the discussion. It should be a fun discussion.
Thank you for the raising the question, and James, for your very thoughtful responses in this discussion. Let me check to see if there are any further comments or questions on the line before we allow James to go on.
So we do have 2 more hands raised. I'll go to the first one. Steve. Steve, go ahead.
And just ask, I mean, I understand why maybe CRRs might be different, but what about the TORs and ETCs on the CAISO system? They're already given a CRN.
Go ahead, sorry, Steve.
I'm sorry, it's just, they already have a CRN. So is the revenue that's caused by their self-scheduling, if it causes this congestion in another BAA, would that flow back to the CAISO then?
So the ISO, as a market operator in our settlement system, we are going to perform the perfect hedge. So if that TOR has congestion exposure on both ISO constraints and EDAM BAA constraints, they will get the hedge for that, and that money will not be included in the congestion offsets of the BAAs, including our balancing account. So ETCs and TORs are taken care of by the market operator. It's the OAT rights that that's being extended the treatment to is going to be handled by the EDAM BAA.
When you say the market operator, or you have to be more specific. Are you talking about the market operator for the CAISO BAA, or are you talking about the EDAM market operator?
Settlements. When I say market operating, in this case, is settlements will be performing that function. My group, I will be performing that function.
That's kind of like saying an ATM will be handing out the money. Where does the money come from?
So we'll basically do it. I'll calculate what the overall congestion is that's going to each BAA. Then we will determine the TOR balance CRNs. We will determine what that congestion imbalance or the exposure is, and then the settlement system will reverse it to bring the TORs and ETCs congestion exposure down to pretty much nothing, it's perfect hedge. And then I reduce overall the congestion offsets before I even pay it to the entity. So I am going to the settlement system is going to perform the hedge for TORs and ETCs in all balancing authority areas before even distributing the congestion revenue to the BAAs. As part of that function, I'm going to identify the OAT hedge amounts and put it in the appropriate BAA's bucket.
Right, but are you going to charge the other BAAs for the congestion that our TORs and ETCs created on their system, so that it goes back to Abram's point, if we just make this up by paying it out of the fund to the TORs and ETCs, it just makes the shortfall for the CRRs larger. But if we're going to say, well, these are the equivalent of OAT firm transmission rights, then shouldn't the CAISO be able to collect the charges from the other, reduce the congestion collections of the other BAA? I think that's what Jim and Ben were headed at.
So in essence, I am, because they are self-scheduling. Let's say my example at 100 megawatts where the congestion difference was $10. It was $6 for the ISO constraint, $4 for EDAM constraint. The TOR is going to be settled at the LMP. they've got the $10 exposure. My settlement system is going to take that $10 exposure, pay it back to the financial SC, and then I'm going to remove that $6 and $4 from the relevant offset account, and so that money never gets distributed.
What do you mean never gets distributed? I don't understand. The question is, you paid out, you didn't charge $10 to the TOR for congestion. Now, $4 of that was in our system, and they, you know, we just didn't charge them, but that's no different from today. But how about the $6 that goes to another system because it's a constraint on their system? Then
so the way to look at it is, yeah, the way I'm looking at it is, so when I calculate or set up the LMP, I've increased the offset in each BAA by $6 and $4. Now, when I do the reversal of the TOR balance schedules, I reduce those offsets by $6 and $4.
Okay, so
that means
we are going to use this mechanism for TORs and ETCs to rebate back the congestion charges in other systems, right?
Correct. It's just the person doing that rebate is what is different.
Well, I mean, it's always the CAISO settlements, isn't it? I mean,
no. So the CAISO settlements is going to do the direct settlement of TORs and ETCs with the financial SC. The OAT, I'm calculating the dollar values that the EDEM entity is going to use to fund the hedge.
That's what we're talking about. You are going to charge the EDEM entity and you're going to give money to the EDEM entity. So it's the same thing. It's just a matter of you're going to take the money from them for our TOR and ETCs, and we're going to give the money to them for their firm transmission rights. Okay.
Fair enough. Yes.
All right, so we do have another hand raised from Kathleen. Kathleen, go ahead.
Great, thank you. This is Kathleen Colbert from Vistra. Can you hear me?
Yes, Kathleen.
Oh, great. And thanks, James, so much for this. I also really appreciate the dialogue between you, the MSC, and Avram. And if it's all right, Dr. Hobbs, I want to, the way that you said, how bad could it be is the world that I've been living in. And as I've been thinking through this effort, we have assets internal to California that we have CRR positions around that are really important for us to be able to hedge our risks. And so, I mean, it's a real risk, right? We're physical hedgers. This isn't a hypothetical concern. And as I've been thinking through how bad can it be, we also want to be in a position of like supporting the end goal of the CAISO to try to resolve what is in and of itself status quo right now doesn't seem to be treating firm or firm equivalent rights equitably. So like that's not great today. Where would we go tomorrow? So we're trying to row in the same direction. But I wanted to add and see if I could get some feedback from James, you or the MSC on, I feel like we can be more supportive of this interim or transitional approach with the recognition that it does increase risks of CRR underfundings under our current approach, if we can pair this implementation with improvements to the funding design. At the simplest level, you know, one thought is that right now you have a monthly constraint that's deficit, and that's underfunded constraint that cannot be netted against another constraint on the CAISO system that has a surplus on a monthly basis. Whereas we view the whole funding approach kind of more on a system basis, which also sort of aligns with the policy direction as we're talking about allocating funds based on BAAs and within systems. I think that one of the risks we already know is happening is that we have surplus constraints on a monthly basis that are not offsetting and being used to fund deficit constraints. And if we recognize there's a risk of increased underfunding on a constraint level, if we can pair it with an improvement to do more of a system netting on a transitional basis, I think I can get more comfortable with at least a balance of these risks. And I wanted to see, I recognize this is complex and other markets treat the netting differently and have more complicated methods, that I had hoped that we would have deep dives with the MSC on all those options. But just given this timeline, I would like a sense of, is there a pathway to try to balance these risks better by pursuing this kind of something akin to this, and hear from you all. Thanks.
So I'll start is with not being part of the policy team and not having time to have a further discussion as to where we should be addressing this. I know we will address it. I just don't know what format we're going to address it, or if we're going to connect it with the congestion revenue initiative as well. I will, in short, I would have to get back to you.
Understood. Thanks, James. MSC, do you guys have any reactions just on a theoretical level, if you think this would be a good direction to start working on?
Well, I'll just say, and I said this at the last MSC meeting when we talked about CRRs. I've been worried about the constraint-based clawback rules for 6 years, and I think we should seriously consider something about just pooling what the overall revenue inadequacy shortfall might be, and just doing some kind of pure pro rata haircut rather than trying to identify constraint by constraint, which is going maybe a bit beyond what you're talking about. But and I don't know about the degree one wants to or not wants to link this with this initiative, but I'll just say overall, I don't think that the constraint. I think the constraint-based approach to the CRR funding shortfalls has been just not worth it, because it creates so much uncertainty about the value of the CRRs.
Thanks, Jim. I appreciate that feedback.
So Jim, that would be a much broader discussion about the whole CRR system and its design.
All right, it looks like we do have another hand raised from Doug. Doug, go ahead.
Hi, Doug Boccignone, the Bay Area Municipal Transmission Group. Thanks for the presentation, James, and the interesting discussion from everyone. I wanted to follow up a little bit more on the idea, the example that you gave, where there's a constraint, within the ISO that's being, impacted by schedules outside the ISO. And if I understood correctly, right, that the LMPs are going to reflect all the contributions to the constraint. And it seems like at first, when you talk about the ETCs and TORs within the ISO, you're going to collect the revenues you need for that perfect hedge. But what if some of the contributions to the constraint in the CAISO are coming from external BAAs, parties who are scheduling using their contract reference numbers? How do you keep both whole?
That's where, from the settlement system, I am going to provide the perfect hedge for TORs and ETCs first. And so then whatever is left over, it gets to go to the congestion offset. That's going to be a similar thing that has to occur when you're doing the OAT hedge calculations. It can change the overall offset, but in theory is that, if you have congestion revenue, it should be okay. I'm not sure how I get what is a great answer to give you, other than the settlement system will ensure ETCs and TORs receive their perfect hedge, and then we are going to calculate the OAT hedge to provide to the entity so they can perform their hedge mechanism.
Yeah, and I appreciate that, but it seems like I'm sort of thinking about James Bushnell's comment about the ATM, right? The money has to come from somewhere, and it sounds like, you know, to the extent there's non-ETC Tor and non-OAT self-schedules with CRNs that are contributing to this, there will be revenues being collected, but and
all of the revenue is coming from the settlement of energy at the LMP, imbalance reserve between what we paid the awards and what we've collected from the imbalance reserve requirement, and then and for the ISO, an additional congestion for any ancillary services. So that's where the money's coming from.
And in a particular interval, there you might not have been able to satisfy all those obligations, but across multiple, I think it sounds like you're thinking you will be.
Well, and what will happen is if I haven't collected enough, since the settlement system we're revenue neutral, we will go collect more, and that will be from the appropriate measure demand.
Right,
So
and I
give
think
it to the entity.
CRR settlements, but remember already today, we have to model those loop flows and parallel flows in the IFM. We already do that.
Right.
And, you know, but we may not do enough of it. I mean, that's what Guillermo's analysis, you know, highlighted, is that there's some unpriced flows that use up a lot of space on those constraints in the IFM so that we don't collect money already. So this is, you know, we got have an inconsistency today between what we model in the CR auction and what's available in the IFM. Now that may be, you know, hard to model in the CR auction because it's, you know, parallel flows on particular days and particular hours, and our auction model doesn't run that way. But that's what we're going to have here too. You know, we're going to have shortfalls in the IFM due to those parallel flows, and it may be hard to model them in the CR auction. But I don't think it's that necessarily different from what we already do, you know, in the shortfalls we already have. So that's one perspective to keep in mind on this.
Yeah, no, I think that's a really good point, and I think I've mentioned in the past we probably have to think about, are we doing a good job? Can we do a better job in the allocation and auction of modeling the parallel flows? But and I'm just thinking also about some of the comments Abram made about, you know, the CRRs, you know, the impacts on CRRs, and I get that, like, how we're going to deal with that may need to be in a different initiative, but to the extent this initiative is going to impact the bucket of money that the ISO will have to settle with the CRR holders, I think we have to be considering that as part of this initiative.
I think we need to answer the first question that I think Ben was highlighting, is what is CRRs providing you the hedge for? Is it for ISO constraints, or is that we are proposing that is for all constraints in the EDAM footprint? So yes, I see there is a connection here, but until we completely answer that first question, then I don't see it having an impact, this having an impact yet.
Yeah, and I get that if you're talking about like auction CRRs, but if you're talking about somebody who's using the CRRs as a hedge against the congestion exposure they're really seeing from actual transactions that they're doing and how their load is settled, that congestion isn't, the LMPs they see are going to reflect both CAISO congestion and the congestion from the external areas. And they're going to do it in a better way, which is, you know, part of the whole objective of EDAM. And so, you know, the reality is this is going to change. The loads are going to settle based on the prices that are produced by the market. And it sounds like the CRRs, you know, aren't going to be collecting, or there's not going to be as much funding available to cover the same percentage of that exposure, I think. And I think that's what's the concern Abram was raising.
I understand what everyone was saying. I think that's why I think we need to take this discussion offline. Because I've stated before is CR1B will look at all constraints. It will look at ISO schedule's contribution on all constraints to determine what is to be paid out to CRR holders. That aligns CRR holders' congestion hedge with what that schedule was charged from an LMP perspective. It's that second element where we have collected through the market settlement of awards that goes to offset what we say CR holders should be paid, that we have that disconnect. So I don't want to try to draw something on the fly.
Yeah, no, I'm not expecting you to, James. I'm just saying, I think it seems difficult, like if we're going to like come to a decision on this, and this has an impact on this other, it's going to determine what options we have available to us, or what we'll be facing, right? The pot of money that's going to be available to cover the obligations. And I think we should go into make this decision with the best information we have available to us.
Okay.
Thank you.
Thank you, Doug.
Okay, Ryan, I think that was the last one, or is there another one?
Abram wanted to follow up real quick.
Okay, I also see Steve and Kathleen queued up. Okay.
No, I just couldn't lower their hands. It has to be collective, so I'll just wait until they're all finished.
Okay. Abram.
Hi, thank you. And Doug, thanks for the comment. I just wanted to follow up real quick, which is that, this whole system works really, really well in terms of making whole everybody's firm transmission rights when the whole transmission network is available. But one of the concerns that I raised is when there's an outage, if you provide the perfect hedge to the ETCs and TRRs, and that's not so bad, but if you're also providing the perfect hedge now to the external BAAs for their firm rights, but not, especially the network transmission rights, not even the firm point-to-points, but not to the California rights, the situation gets a lot worse. And to Scott's point, while it is the case that external BAAs are able to use California's transmission system for free, you're going to have a whole new set of incentives that are created once market participants see the LMPs and choose to schedule their network service rights in a way to maximize the value of those rights. I think it probably gets in a little bit to Scott's next question, but you're going to have a challenge of making this problem worse because entities will see the prices. And one thing we know about firms that do scheduling in the West is they're very good at following the prices and the incentives and doing that. And so you really do have the potential for this situation to become a lot worse if people are able to adjust their schedules or their self-schedules in a way to capture the rights once they see the external congestion that's currently hidden from them. Currently the external BAA is just redispatching to manage their own system. You're going to shift that responsibility to California and have their trading groups now try to optimize to make the most money and or meet their load at the least cost, which is what they should do, and it's going to worsen this problem very potentially. Thank you.
I'm not sure about that, Abram, because the fact is they can do that today with the base schedules in the WEAM. They can set up base schedules that create more congestion on the CAISO and then be dispatched down. And I'm going to talk about that later. I think it's complicated to assess whether it's going to get worse or not, and there are a lot of complicated constraints on that.
Okay,
but the issue you raised of not, to the extent we don't collect congestion on their constraints, that's,
Yeah, there is a, I think it does highlight the importance of moving towards some system that will incentivize people to use the EDAM and follow dispatch in a way that is optimal for the whole market. But yeah, I'm very supportive of the effort overall.
Sorry, James, we tied you up in for an hour on one slide, but maybe it's fine,
Well, Scott, my promise to get you to bed earlier is not going to happen. I apologize. So we can move on to the next slide. I'm going to skip the next slide. We've kind of already talked about it. It's regarding what is a point-to-point and what is NIT. Now, this is where I think part of our discussion is going is, how is this design going to evolve? How are we going to take if we move forward with this proposal, what are the near-term and long-term design goals? The first goal is to set up monitoring. We're going to monitoring the binding transmission constraints, determine their frequency, the resulting price effects, which I think we can, and congestion revenue allocation, which I think we can lump in here, congestion revenue rights distribution, which will then inform us what we are going to do during year 1 or year 2 of EDAM operations. We can start some of this discussion beforehand, but at least we can use that information to formulate the direction we want to go. The second thing we want to commit to is within a 3-year period, the ISO will present a long-term solution emerging from a stakeholder process regarding all the governing entities for consideration. So we're going to be trying to move along into a long-term process that addresses a lot of these questions. And lastly, the ISO and stakeholders will consider near-term enhancements as needed. And this goes back to the CRR or anything else that unforeseen pops up. If we see there is something that needs to be done sooner, then we will do potentially an expedited process to try and resolve that issue. We can go next slide.
I have a suggestion on this. The monitoring things. I think there's room for the CAISO to study some of this stuff now. We talked about the question of what's the impact of flows from Northern California to Southern California on constraints in, the Southwest or Pacific or East or wherever. I mean, I think we could get some idea by looking at, what are the shift factors in the WEAM model of, flows from somewhere in some generator in Southern California up to meet load in PG&E or replace some generator in PG&E and say, does it actually materially impact any constraints in the Southwest? Because, I mean, if we could tell the stakeholders that the answer is no, that we got more change in our pocket than the impact on the ratepayers, I think they would be less urgent about fixing this now versus later. On the other hand, if we find out that it's a lot of money, then it would mean, well, maybe we ought to put more effort into nailing this down right now. So I think, similarly in terms of, we know what the base schedule impacts are, and that some of those are firm. I guess we have to back out what are the firm transmission rights, but we know, when are the flows on the CAISO system that the WEAM flows that cause constraints. Can we get any sense about how much money this is actually going to be? Because it's.
I think that's a great suggestion, Scott. I think there's a lot of efforts that would have to go in doing this. So I will take this back to talk to Anna and Mark as to what we can commit to. I'm not in a position to commit to it.
Right, I know. I'm just making the suggestion for all the stakeholders because, I mean, it's also going to take you a lot of effort to run down and solve every rat hole. And if some of them are pocket change, then we say we don't have to put resources into that because it's pocket change. And on the other hand, this one we need to fix. So I think, there are some cost savings for the CAISO in terms of focusing effort on things that matter. But enough of a
I
rant.
appreciate and agree with you. So I just have to have that discussion. So we move on to the next slide where it's going through the proposed timelines right now. Obviously, we're at we're April 23rd, we did a stakeholder workshop on the published draft final proposal. We are having the MSC, we don't have it on here, but we have the MSC meeting right now. On May 5th, comments deadline for the draft final proposal and the workshop. The 12th, the publication of a final proposal on this initiative. And then May 20th, 22nd, the presentation for decision to the ISO Board of Governors and WEIM governing body. Now, if we go to the next slide, I have the examples. We have gone through the examples several times. I'm going to ask in the efforts of time constraints, do we want to go through the examples again? At least one of them.
I mean, Scott has examples too, so I do wonder to the extent they serve the same purpose that it's not necessary, but.
Yeah, I don't think you need to go through them, but you know,
Yeah.
anybody else? I mean,
No, but I did have a different line of questions that we can either, I'll raise it and we can decide whether to discuss it now or not.
Raise it.
So, and I guess I've been trying to understand, and I know like just how many rights are out there is one sort of issue, and I understand that the units of measurement are difficult because some are nits and some are point to point and so forth, and the denominator is unclear. But some levels of magnitude. But I guess more importantly, it's now become clear that this transitional proposal affects newly marketed rights, at least monthly rights, going forward during this whatever transition period would be as well. And I guess I'm trying to understand the principles that impact how many of these types of rights a BAA can market, because it seems that the incentives to market them are affected by this, because they get to essentially, you know, collect the congestion from other BAs that the rights they're marketing might be imposing going forward. And it seems like some principles to try to, you know, limit that. I just don't really understand what constrains it today and how those sorts of considerations would factor in. And then the discussion over the last hour sort of added a new dimension, which was if they're trying to decide whether to continue to sell monthly like traditional firm OAT rights or transition to a CRR system, you know, I now worry that that if there is an asymmetric treatment, that it's going to favor like marketing of OAT rights. So there's sort of a how many, and then there's another question of when a BAA sells its OAT rights, where does that money go? It goes, I assume, to offset their capital costs of transmission that would otherwise be paid probably by the load that is buying from using that transmission. And so I'm just trying to sort of identify a kind of BAA incentives, you know, effects of this sort of proposal.
So to the first question, I do not know. That's what with the effort that Scott had talked about, that would be what one of the first steps we would have to figure out is what rights under today's WEIM are considered OAT firm rights that they would potentially self-schedule so that we could start doing that analysis. So I don't know. I would need the input from the EDAM BAAs on those particular firm rights and the megawatts and where source and sync for what they are from.
Okay, James, let me just, so it sounds like you do have a sense of all of the rights that are being used, but you don't know sort of which ones are firm versus some other form. Is that what you're saying? Or
in essence, I'm assuming, making the assumption that base schedules is probably a good representation of all of the firm rights being used going into the real-time market. I just don't know of those base schedules where the line is drawn between long-term, monthly, short-term firm rights, and even non-firm rights.
Okay, I guess I thought of base schedules from a vertically integrated system that they wouldn't need OAT rights to support their own sort of schedules, but
Well, it's network transmission service, so they'd have network transmission service for their schedules, and they'd have they might I think James' point is they could be selling under daily firm or non-firm, so it's possible that some of those base schedules are actually not going to be covered by this. So it's conceivable that the actual the parallel flows will be free could be lower under this.
Correct. Now, the question on continuing selling of the rights, I'm going to pull on an answer that Kathy Anderson gave, is that at this time, there isn't a lot of unsold firm rights, long-term or monthly firm rights, and when they become available, they have to sell them right away. And so I don't know what the continued sales numbers would be in relationship to what's there now. I would think that the main contribution it would be is new transmission itself. Is if you build new transmission that comes into activation during EDAM, what are they able to sell long-term rights on it, and whether or not that qualifies. If I reference the filed tariffs of PacifiCorp and Portland General, they have identified in their transmittal letter and their responses to their filings that the OAT rights that this hedge is applying to is monthly, long-term, that are active upon entering EDAM. And so my assumption is those are the rights that they are going to limit these OAT transaction to. Because they are providing the hedge.
Yeah, and I'm much less familiar with how OAT markets work, but so it sounds like a monthly right is one of these that's sort of renewable. It's not like a monthly CRR where there's just sort of, they all go back and you buy them again. And there's a whole new sort of feasibility associated with it. So when 1 month expires, it sort of automatically rolls over, or is there some new determination of whether it's still feasible in whatever, sort of version of feasibility is applied to marketing these sorts of rights?
And I'll be honest, I'm with you. I'm not the expert on OAT, and I'm going to try and pull from my panel of helpers.
And I guess and I guess my concern is under the current sort of state of affairs, there's an inherent sort of conservatism where you don't want to oversell, rights. And this may not like completely, it seems like on the margins, this changes some of the incentives in terms of how many to make available. And let me just ask a third version of this I just remembered. I've been trying to kind of think about, again, bounds to how much might be shifted. And one bound would be the original transitional proposal that you then modified for the DFP, where, the big difference is, okay, we're only doing the shift of the congestion costs. I guess let's just call the shift back from the impacted BA to the BA where it's collected in nodal prices, a shift. That we're limiting that to that necessary to cover these rights. Whereas the original proposal was all of the nodal price differences collected within a BAA. Is it possible that the amount needed to cover the rights could actually be greater than the nodal price collections within a BAA? And that's sort of one bound I've been trying to get my head around. And I could see in a CRR world, it could be because you could just keep selling rights and there's no real physical limitations. But in this world, I don't quite have the intuition for whether, the need to physically, the nodal price collections are going to be based upon actual quantities at each node. Whereas I don't know whether the schedules will have to match those or not.
Yeah, so the schedules have to match they have to self-schedule, and so the amount of hedge that I'm going to be giving back is going to be directly tied to their balanced self-schedule. The answer to the overall question is it could happen. I could have a situation where the constraint says of energy coming over to a BA based upon the constraint finding is based upon all schedules. And now when I go to take out one particular schedule, it can cause a shift that theoretically could be your short, and then you'll have to collect more revenue from that BAA. But that's a normal congestion offset allocation methodology that I have to deal with anyways. And so in theory, though, is if you are dispatching resources at a constraint level or based to resolve a constraint, and you are determining what the overall congestion revenue based upon those constraints in a day ahead, I don't expect it to happen. Where it happens frequently is real time, because now you're getting into meter. And this doesn't carry over into real time. So I hope I answered your question.
Yeah, I mean, I was gonna say if it's possible, but and even like remotely likely, one could bound the transfer at what would arise under the original proposal. Because I mean, the intent of the draft final proposal shift here, I think, was to reduce the amount of this, and if it actually could increase it in some circumstances, I'm not sure that. But if it's a remote, unlikely thing, then maybe that falls in the monitoring bucket and see if this curiosity could actually happen in real life.
From the initial proposal, I don't see it happening. From the EDAM approved tariff language is where I see it can happen.
Oh yeah. No, I was talking about the let's call it version 2, the original transitional proposal, which would move all of the sort of congestion from other impacted BAs back to where it's collected. That's kind of the comparison I had in mind.
Yeah, no, you're basically getting a subset. The moving it all would be your largest amount that could ever occur. So we should have a subset of that. Because if every schedule within that BAA is OAT, it would look very similar to
the original
that interim. Yeah.
So we do have a hand raised from Mark Price if we want to take his hand.
Sure.
All right, Mark, you're unmuted.
Yeah, this is Mark Price from DC Energy. Are you guys able to hear me all right?
I can hear you, Mark.
Great. My comment goes to the, I guess, the data that will be collected during the transition period. We like the sort of what CAISO's put out there in terms of what they plan to collect, but I think it's very important that the level of granularity of that data. If we just aggregate it at a EDAM level or at a BAA level, we might not have the data that we need to make some of these important decisions on how the market should look in the future. I think in particular to some of the concerns that Abram had brought up about CAISO CRRs versus PTP and other BAAs, we need sort of level of you know, constraints, like how does this work on a constraint by constraint basis, and even having pricing level down to, you know, even like shift factors, nodal pricing on some of these constraints and where the money is going to on each constraint basis to help us sort of walk through examples of how this plays out and how we can correct some of the maybe issues that do arise. So we like what we see in terms of the proposal. We just want to make sure that it's at a granular level that will help aid our discussions. Thanks.
Thanks, Mark.
Okay. I don't see anybody else queued up. So James, we could perhaps give you a breather here, and we can go to, I think it's Scott's presentation next.
Thank you, everybody.
Really, we
Thanks.
appreciate your effort in the discussion.
Okay, I'm going to replow some of the same ground, but from a different perspective and raise some questions. Now, some of this I'm going to have to change. Maybe I'll repost it, because in the course of discussions last night, and as you heard today in the discussion, you know, my understanding of the treatment of counterflow rights and how they're treated continues to evolve. So I'll try to cover that as we go through it. There's some things that you know, need to be reconsidered. Okay, let's go to slide 3. One more. Okay, I thought a good starting point would be to outline some high-level goals that I think we ought to have in mind as objectives when we're devising whatever system we put in place. And one goal should be to consistent with resource participation in the day-ahead market and real-time dispatch, and not incenting self-scheduling, and also not distorting bidding schedules so that they don't really self-schedule, but they bid in a way so that they are self-scheduled. And this applies to resources that could be dispatched up or down, because if we start distorting these incentives, we're going to lose some of the benefits of EDM, and we may create reliability risks. And then we also want to try to enable the provision of congestion hedges that are at least reasonably consistent with the transfer capability of the grid, or are supported by the out-of-merit dispatch of the balancing area generation that the balancing area is willing to pay for. And third, we want the balancing areas to be able to preserve the rough benefit of the bargain for the parties to existing transmission contracts, so that they get enough money that they can, they're roughly whole. And everybody's roughly whole on the way they, but not necessarily whole on every aspect, but overall, because you might get better off in one respect and worse off in another, but overall you got the benefit of the bargain, and also avoid undue cost shifts. So those are what I have in mind as objectives. And I'm going to focus a lot on the first one in this discussion. Any comments from you, Ben or Jim, on this, on the goals before I shift gears a little bit?
I really like this taxonomy here.
Carry on.
Okay, go to the next slide, please. So what I'm going to do in the next, you know, bunch of pages is go through a very simple example, and to highlight some of the issues we see, and do it in the context of an example that's so simple that we can see it, but it also has got the shift factors and the shadow prices and all of that, so it's internally consistent. So I just have 4 buses, and I've got equal, you know, resistance and 0 reactance on all the lines, so everything's the same impedance, and you know, that'll help visualize the how the line flows are. Here we got the start, 200 megawatts being injected at D, 50 at C, and 250 being withdrawn, and red BA has 250 of load and 250 of generation. Go to the next slide. And this just adds the flows associated with it. So the 200 megawatts that we inject at A, because of the way we stylized the resistance and impedance of the line, 50 megawatts flows around in the parallel path through green BA, and 150 megawatts flows over the direct line between A and B. And the 200 megawatts being injected at D does exactly the same thing. You know, 50 megawatts flows around through red BA, and 150 megawatts flows up to C. And we can see that the flows on the line DC are 200 megawatts, which is the limit. So this is a valid dispatch, and we don't have any overloads, and we can see the parallel flows. Go to the next slide. Now what I've done here is added the the LMP prices and the marginal generators. Notice that A, I've got 200 megawatts being injected at $15, but it's all injected, it's not marginal. At the other locations at D and C, we've got generation on the marginal because we at the margin because we can dispatch it up or down. We've got more supply, and that sets the prices. There's one constraint in this example, the constraint on the flows from D to C that's binding. There are 200 megawatts of flows and 200 megawatt limit, and the shadow price of the constraint is $40, and the 0.75 shift factor of generation at D to meet load at C means that at $30, there's a $30 difference. So that's why it's $10, $40 at C and $10 at D, and all the prices at A and B can also just be derived the same way. The shift factor of generation A on the constraint to meet load at C is 0.5, so it's a $20 price. And the constraint and generation, if there were generation injected at B, only, you know, one fourth would flow around. I mean, 1/3 would flow around in the parallel path, so it's only got a $10 cost. So that's all that's going on, and everything's, and you know, I got a note about how you could calculate the shadow price if you want. So this is a simple example. Go to the next slide, and I'm not going to go through this, but I just wanted to show this because some of the, you know, the examples have been used were a little contrived, and there were anomalous results. But this is just to point out that there are 4 ways you can calculate congestion rents, and they should always add up to the same numbers. If they don't, there's something wrong with the example. So you can just, table 1A, it just multiplies the quantity injected at each price times at each bus times the price, you know, just the signs of the loads and generation, you got $8,000 left over. 1B, that just sets it up as transactions from A to B and D to C and charges the difference in price, and you get the same congestion rent calculations. Table 1D down at the bottom just charges the 200 megawatt flows over the constraint times the shadow price of the constraint. And then table 1C over there on the side just multiplies by the congestion components. And all of these things work out the same. Go to the next slide. Now we got some LSEs in here, and the cost of meeting load for Red BA is the 4,000 megawatts of generation cost at A, or actually I changed it from $20 to $15, it'd be 3,000, but plus a congestion charge of $10 on 200 megawatts from A to B for a total cost of 5,000 or 6,000, whichever energy cost we're using. And then for green, it's got 4,000 generation cost at C and D, a $30 megawatt congestion charge, so our total cost of 10,000. But then the total charge of the balancing area loads would be 16,000, but there'd be 8,000 in congestion rents that could be allocated, so it would reduce the overall cost of meeting load to the production cost. So that's just the basic. This is just the least cost dispatch. Now I'm going to go to the next slide. Now I'm going to start talking about self-scheduling. Let's suppose that the cost of the generation was $25 rather than 15 or 20 as an example 1. Now, if this were the case, the least cost dispatch would be to dispatch generation up at C and up at D and dispatch the generation at A down to 0, because we can meet the load at B with generation at D and C by backing down A. And what we do is dispatching up C to 116.6 megawatts would create counterflow over that constraint because part of it flows around. You can see 33 megawatts flows around in the, part of it flows around in the parallel path, and it creates more ability to generate more generation at D. And so we can replace the generation at B with this other, and the prices don't change. We still have exactly the same prices, and the shadow price of the constraint is exactly the same. Go to the next slide. Now, in this case, price of power at B is still $30. So Red BA would have to pay $6,000 to pay 200 megawatts of power. And if Red BA received $2,000 of congestion rebates for the congestion charges it pay, you know, its net cost of meeting load would be only $4,000. Fine. But if we only get the $2,000 of congestion rents, if we run the generation at A, and as we talked about in the proposal, then Red BA wouldn't get any congestion rents when the generation at A was dispatched. So Red's cost of meeting load would then be $6,000, much higher. Go to the next slide. But Red BAA, if it's self-scheduled, even though its generation today costs $25 and it's only worth $20 in the market, it would lower its cost because it would, if it just participates in the market, its cost is $6,000, 200 megawatts times $30 it has to buy. If you self-schedule high-cost generation, you pay $5,000 for the generation, $2,000 for congestion, but then you get $2,000 of congestion rebates, so your cost is only $5,000. So self-scheduling saves money. And there's been talk about there's some offsetting benefit from participating in the dispatch. There's no offsetting benefit here. The only thing that happens is your cost of meeting load goes up, and your regulator would say, what's wrong with you, Joe? Why did you do this? And your shareholders are going to be responsible for this mistake. So it's lower cost in this world to participate in the economic dispatch. To lower cost in this world to self-schedule than to participate in the dispatch, which that's what raises your cost of meeting load. Go to the next slide. So now I'm going to talk about self-scheduling. Well, no, let me stop. Are there any questions out there about from you or Ben or Jim or anybody else on the phone about example 2? Okay, it doesn't sound like it, so we'll go ahead.
No. Yeah, I guess I would.
No, go ahead. Good job.
I was just going to point out that under the original transitional proposal, it's a little different, right?
Because I've got everything here as being firm network service. So
Yeah. Oh, okay.
The difference would be if some of it were non-firm, then you wouldn't get it. And I didn't do that in the example. Maybe.
Okay. If everything's already a right.
Right.
Then,
right.
Then there really isn't a difference.
Yeah.
Okay.
Now, what I do here is I'm going to make the example a little different because I'm going to assume that Red BA is a load of 300 megawatts rather than 200 megawatts at B. And the least cost way to meet this is it's got 100 megawatts of generation with the cost of $27 at B. And the cost of generation a day is still $25 as an example 2, and it's still self-scheduled. So if this were the case, the dispatch would be the same as an example 2, except with the additional 100 megawatts of load at B being met with 100 megawatts of generation at B, but none of the flows around the system would change because we just have the offsetting injections and withdrawals at B that wouldn't change the flows. And the cost of meeting load would be $7,700, $5,000 as an example 2 for the generation a day, and an additional $2,700 for the generation at B. So, $7,700. Go to the next slide. But suppose, that generation a day used network service or point-to-point rights and using it entitled Red to get congestion rents on the flows over DC. Then it'd be more economic for Red BA to self-schedule the generation a day to operate at 300 megawatts and meet the entire load a day than to dispatch its generation, because the increased cost today is $25. It displaced the $27 generation at B, so it reduced the cost of meeting load for B by $200 if it didn't have to pay any congestion charges. Go to next slide, please. But that dispatch would increase Red BA's flows over the constrained D to C line and displace the $10 Green BA generation at D and replace it with $40 generation at C. So now we got a completely different least cost dispatch. You can see the flows of Red BA over the constraint have gone up to 75 megawatts, and Green BA's had to reduce its generation from 200 to 166 megawatts at D, so it has to use more expensive generation at C to meet its load. Go to the next slide. So overall, the cost of meeting load would rise from $11,700 if the $27 generation was dispatched to $12,500 if A self-schedules the generation. But Red BA is better off. It just saved $200, but the cost of meeting load to Green BA went up by $1,000. So the self-scheduling here, it's good for Red BA to self-schedule. It saves money, but the self-scheduling is inefficient and it drives up the cost of meeting load to Green BA by $1,000. So this is again the potential inefficiency in the self-scheduling design. Go ahead to the next slide. I guess I should stop here. And are there any questions by any Ben or Jim or anybody else about that third example? Okay. Now I created this example to talk about the counterflow, and there's some things I might have to change a little bit because of what we heard in the discussion today and my clarification. But what I've done is added a IPP at B, which has bought firm transmission to serve a 50 megawatt load a day that was previously served by its own generation. So you can see that IPP with it, now it's got a cost of $27 and it's injecting at B and it's serving a 50 megawatt load down there at A. And it provides counterflow over the constraint because some of the power flows around the parallel path. So you can see that as a result of that injection, green BAA, in the previous examples, it could only dispatch 200 megawatts of its cheap generation a day. But in this example, it can dispatch up to 216 megawatts at A. So it's able to increase its use of its transmission and reduce its use of the $40 generation. Go to the next slide. So the impact is that the injections withdrawals reduce the flows over the constraint by 12.5 megawatts, and that allows Green BA to dispatch low-cost generation at D and reduce the dispatch of higher-cost generation at C. So it's the $40 shadow price of the constraint times the 12.5 megawatts that we reduce the flows is $50, and the $50 benefit to Green BA is equal to the payment that you get for the B to A counterflow transaction, which would be the $10 difference times 50 megawatts. So this is how this all works out, that it's self-funding in an LMP market, that the value of the counterflow is the value of the counterflow. It's the value to Green BA from having that counterflow that makes more of that transmission line available to Green BA for use. So this is how this all hangs together. Now the fifth example is just making go to the next slide, please. And this isn't really complicated, but I'm just going to this is a different grid because now I've got 8 buses in there and we got the generation still being injected at A and withdrawn at B, but the contract path is going around from A to Z to Y to X to W to B. It's a much more high impedance line, so much more of the power is flowing over the D to C path, the A to D to C to B path, than over the long path, the weak path around the other way. So actually more of the power injected at A flows over the Green BA line than over around the contract path. And that's just to make the point that, the amount of the flows depends on how weak this contract path is. And the contract path isn't necessarily the way that the power flows, as we know. Go to next slide. So this example required the Green BA dispatches low-cost generation at C down to 85 megawatts. So it's actually only flowing 75 megawatts over its line CD with 10 megawatts or so flowing around the parallel path. Now in the east, this would be curtailed by a TLR because it's that the red BA is using all the transmission on the green BA system. But this is just to illustrate this concept. So let me go and go to the next slide. And this follows up on what we were talking about. If we're talking about WEAM, red BA's transactions would generally be included in its base schedules. So no congestion charge would be paid for the base schedule for flow impacts on green BA, and congestion charges would be paid for the flow impacts of resources dispatched above their base schedule, such as if B or C were dispatched up in the examples. But there'd be no payments for the base schedules. Now, and then no counterflow payments would be received for the counterflow provided for those base schedules. Because if it's in the base schedule, that's it. You settle for deviations from the base schedule. If your base schedule provides counterflow, that's it. You don't get paid for that. You'd only get paid if you got dispatched above that. So go to the next slide. Now, it's possible, we have to keep this in mind, that this current system isn't perfect, there might be some strategic scheduling and Weem-based schedules of high-cost resources, you know, running the $25 resource at a place that's it costs 20, but you wouldn't run it. You just sort of put it in your base schedule, knowing that when you got to the market, it'd be dispatched down. And then you'd be selling back your schedule for a profit and getting dispatched. But, you know, this is constrained. We don't know how much of this is going on. The need to pass the resource sufficiency test would constrain you from putting in a lot of this stuff, but there is some room for this to be going on, so it might be happening. Go to the next slide. Now, the current tariff is different from that. As we've talked about, it would charge for all the parallel flow congestion and pay for all the counterflow. So there'd be no inefficient scheduling incentives, like I talked about for the red BA, because they'd have to pay for everything. They would never want to self-schedule an uneconomic resource to run because it costs them money. On the other hand, the problem we've talked about is it also doesn't pay there's no hedge for congestion charges on parallel flows attributable to firm transmission schedules of any type. So if we look at this, the current EWDM tariff is less favorable than Weem to firm transmission customers whose transactions contribute to congestion, and more favorable to firm transmission customers whose transactions provide counterflow. Now, the one element of this is that the Weem, yeah, well, no, so that's the way that was right. Let me stop for a second and before I go on to the next slide and see if there's any comments from you or Ben. I've gone on for a little bit. Ben or Jim.
I'm good, and there's nobody in queue.
Okay, then I'll just shift to the draft. Next slide. The draft final proposal. Now, one thing I understand about this, there'd be no megawatt cap on the level of unpriced parallel flows due to firm transmission schedules. And this goes back to what a number of market participants and Jim and Ben have talked about, that, you know, there's a little bit of nervousness that this, you know, suppose there's a way to make this go up, there's no cap on how far it would go up. Now my understanding is, and I say here that would pay the LMP price for all counterflow in the day-ahead market, whether associated with firm transmission or not. But now I understand that's not the case. That if you use your firm transmission and put in your CRN code, you would not get paid the LMP price. You'd actually have to pay, you know, you'd lose that. You'd lose some of your revenues. But then the dialogue today with Jim, we understand that if you have your firm transmission and you have to schedule, you have to use your firm transmission, say, because it's an inner balancing area transaction, all you have to do is not put your CRN number in and you get paid for it. So in effect, this is going to be a little bit, you know, better than the Western EIM and balance market, because you're going to get paid for your counterflow. And all you have to do is not put in your CRN number.
So it's an option that could be valuable if sometimes you get counterflow payments, you take them, or in cases where there wouldn't be counterflow payments, you take the perfect hedge.
Right. If you expect there to be prevailing flow, then you take the money, and if you don't expect to be counterflow, and you know, if you go back to the data on first quarter 2024 congestion components and so forth, you could look at some balancing areas where, you know, there were some congestion charges of, you know, $7 or $8 on flows from Pacific Corp East to Pacific Corp West. Well, there are other flows where there was counterflow payments that were larger than that on other flows between balancing areas where people had contracts. So, you know, the counterflow dollars are not necessarily always small, they could be large. And even for Pacific Corp, those transactions from Pacific Corp East to Pacific Corp West, they are reinforcing congestion when there's south to north congestion, but when there's north to south congestion, like once the sun goes down in California, you know, then they're relieving the congestion. So they're counterflow. So that's, you know, these are two aspects, but and the last two bullets are just pointing out what we talked about in that fourth example, that you really don't need any fourth example to I mean, you don't need any special settlements normally. You know, just settling at LMP prices, the counterflow gets the money. Go to the next slide. And as we, and you know, and this is just driving back what I talked about in example 4, that the counterflow would enable more flows of the constraint with green BA, and green BA would collect the congestion rents on those additional flows. So the flows created by the dispatch of generation would create those flows. So green BA would keep the money and they'd be okay. Now, if we're in a bigger grid that's EP of the EDAM, it could be anybody's flows that that increase the flows over that constraint. It could be other BAs, but green BA would still keep the money. So the counterflow would be valuable for them, and we don't need any special cost allocation rules, as was talked about in some of the earlier dialogue. Go to the next example. But we've got this overall problem that if we have a rebate on schedules, self-schedules, such as what we got in the DFP, we can see that incents Red BA or anybody else to uneconomically self-schedule generation at A. And if they just don't put in the CRN number, we're going to pay for the counterflow. Now, the uneconomically scheduled generation at A, it could be firm transmission. It also could just mean network transmission service potentially. Now, most of the time, network transmission service within a balancing area isn't going to create flows, much flows in other balancing areas unless it's a really big balancing area like California, where you can see that, flows from Northern California to South California might create some significant flows in other balancing areas. But we've also got some balancing areas in the West, and I don't know all the details, but you can look at the grid maps and, some of them are a bit scattered and they're connected by transmission lines and there's other lines in between. So there could be some parallel flows on transactions between the balancing areas. So you'd have an incentive potentially to self-schedule just your balancing area generation to meet some of your balancing area load when you knew it was going to be, in the direction of the prevailing flows and create congestion. So we got this incentive both for self-scheduling intertie transactions, which we think are going to create congestion, and potentially, network service within the balancing area if it's such that it's going to create parallel flows of their other balancing areas. So that's one of the consequences we have to think about this design. Go to the next slide. Now, this is, I think this is not going to be such of a problem because I was thinking about if you have to self-schedule the transaction, the counterflow transaction, it would be netted against the other transaction, the 200 megawatts from A to B. But now what would happen would be the A to B would be self-scheduled and the balancing area would get payments for that. And then the transaction from the counterflow transaction from B to A, well, it would just not put in its CRN number. So it wouldn't have to give back the congestion. It wouldn't get netted. It would just be outside, it wouldn't be part of this settlement. I guess the balancing area could also say to the guy, if you don't put in your CRN number, I mean, if you do put in your CRN number and you have to rebate the congestion payment, that's your fault. I'm not going to make you whole. You're going to have to make me whole for reducing the amount I get. That's kind of the way I see this happening. Does that make sense to you, Jim and Ben? Okay, I'll go to the next slide and then go to the next slide and then skip to the next one because this 27 is what I need to change because it doesn't reflect what I learned in discussion with Jim.
Okay.
Yep. Okay, good. Now, this goes back to the point that self-scheduling and the prevailing flows are reduced by the congestion rate calculations of green are reduced by the prevailing flows over the line DC. and they be increased by the counterflows, and they be made whole. And since firm transmission schedules that don't pay congestion are self-scheduled, I assume that the impact of any counterflow would always be to increase flows that are paying money. So the market flows that pay the congestion charges, and the BAA would be made whole for the counterflow. Go to the next slide. So the concern here for EDM is we've got a design that's going to incent self-scheduling, and that's going to reduce the efficiency of the EDM market because we're going to have schedules that don't necessarily minimize cost. We've also got this feature that there's no cap on the level of unpriced flows. So that to me is a concern. Go to the next slide. Now, right now, there's no requirement that resources that are self-scheduled in EDM be self-scheduled in real time. So this is not as bad as it could be. Because you could uneconomically self-schedule in EDM, but then bid them back into the real-time dispatch at your actual cost and get dispatched down. So, you know, if we go back to the example, Red BA could self-schedule its high-cost generation at A in the EDM market, and then offer that generation in real time at its real cost of $25 and get dispatched down and buy back its schedule at a profit. So, you know, in a sense, this real-time flexibility would tend to maintain the efficiency and reliability of the real-time market, even though we got some of this inefficiency in the forward market. Go to the next slide.
It would be a little bit like the deck game, not necessarily with an efficiency loss, but definitely with a transfer of income.
Well, actually, an efficiency gain is the.
Yeah, well, a reduced efficiency loss is what it is.
Yeah.
We wouldn't lose as much because we can unwind it in real time. But it means that the fact that there's no cap, you have to worry about what could they do to increase the amount of the positions and the flows in the EDAM that then doesn't really happen in real time, and they buy it back, but they make money off it.
And I view this as a double-edged sword in the sense of if you made them stick with their schedules rigidly, there's scenarios in which that actually is bad for them and might deter them doing it day ahead, it seems. And so it's kind of like, is there a deterrent effect here?
But it also could make things really bad in real time because in that example, it was still profitable for beat Red to schedule at $25. That was still better to self-schedule and run than to be dispatched down. So it would just mean that we get the inefficiency. They'd still do it in the forward market, but we get the inefficiency.
Right, but aren't there scenarios where they would not want to schedule in the day-ahead market unless they could get out of it and
right, and that's the other part, down here in the lower part of the paragraph. Suppose the cost was $35. I mean, that's how this could get out of control. That, you know, it's one thing if they scheduled the generation that's $25 in EDAM, knowing that, okay, if I had to run, I could do it and it'd still be better off for me. But it could get out of control where they just start putting in self-schedules from resources that are very uneconomic, and then they'd get hosed if they had to run in real time, because then they'd have to run something that's, you know, cost them money. So there's this balancing of how bad this could be, and, you know, how much do balancing areas see an incentive to do this? And
Scott?
Yep.
It's James. A quick question. So if we follow the balancing rules of an ETC tour, they are required to self-schedule in real time in order to get the balancing hedge
right.
or
I'm going to talk about that. Wait 2 slides, James, because I'm going to talk about that.
Sounds great.
So let's go. Are there any questions on this slide? But I'm going to talk about what James brought up. I'm going to keep on this thread for a couple slides. That might be a reason to keep going for another 2 minutes on this.
Yes, we do have 2 hands raised.
Okay, let's take the 2 questions.
Okay, first is Rick. Rick, go ahead.
Hi, Scott. Thank you for the presentation and throughout the day, I appreciate everybody, all the presenters. This is Rick Benitez, BNGC representing. I just have a quick question in regards to the EDAM and the unintended consequences of the congestion and violations in regards to uplift. Is there a potential to look at the unintended consequences of uplift and from the EDAM and reserves and things like that that might be weather related or outage, like the impact of reserves as well, and in the EDAM as well? I mean, sometimes that could be a factor in how things happen. Has there anybody looked at that in the uplift?
Well, I mean, here we're just talking about the congestion rent scheduling. So this doesn't go to whether there's uplift. These people would have to be, if they're self-scheduling, they're not getting any uplift. I mean, that's one of the basic rules. If you self-schedule, you eat it.
Okay, got it. And outages and what about, I'll wait until the end because I'm probably sure you guys are going to cover it in the upcoming, because there's always that potential for unintended consequences with that as well.
I agree with you, Rick. I'm going to talk some more about unintended consequences. I think we've got to be sensitive to that.
Yeah, it's always the end, the end variable that we never think about. I've experienced it over at PJM with that.
Yep. I think there's another person in the queue.
Thank you, Scott.
Yep. Thanks, Rick.
Yes, we have a hand raised from Abram. Go ahead.
Abram?
Yeah, Abram.
Hey, Scott, this is real quick. So you've done this example with the individual BAAs, but assuming that the individual BAAs allocate congestion rents internally to market participants in their region, basically following the same philosophy and rules, don't you have the potential that some of these self-scheduling incentives could occur even for congestion within BAA? Like, for instance, would maybe a market participant has network service and has a unit that's upstream of a major constraint, would be incented to self-schedule rather than make their unit available for redispatch, because they're going to be able to collect congestion rents associated with that unit. Like, suppose that it was a bad constraint and in a given hour prices were like minus $200 there. Well, they can back down the unit, which is what we want them to do. But if they run the unit as a self-schedule, they actually would be causing lots of other units further away to redispatch down and causing a larger redispatch. So I see the potential is potentially worse. And I'm wondering if you were suggesting some rule that requires network transmission service customers to make their units available for redispatch, or if they make them available to EDAM for dispatch, that they can't then subsequently self-schedule and collect the rights, or some rule that would prevent some of these.
Yeah, well, let me take that in two parts. First, Abram, I agree that we have some of these the same issues for self-scheduling within a balancing area, but the balancing area operator wouldn't really have that incentive because it would be his money or her money. But if it flows over someone else's constraint, that's different. We want, then you don't really care. Red BA, if there was a constraint in Red BA would say, well, it doesn't matter to me. I'm not going to self-schedule.
Yeah, but presumably the balancing BA that's collecting the money has to follow some principled approach for allocating the money, and they can't just decide, hey, we're not going to give it to you. If they said, oh, if you self-schedule using your network.
That's not what I was splitting. That's not what I said, Abram.
Okay, sorry.
Because I was saying, if it's the Red BAA and it's its own generation and the constraint is within Red BA, it's not going to do something that raises its cost of dispatch because it's just taking money from itself and giving it back to itself. But for someone else, if you've got some other generator embedded in the balancing area,
exactly,
then you've got this incentive, and they'd be incented to self-schedule an EDAM the same way. Now, the balancing areas know how much they've got and they can make an assessment, but that's the danger of this self-scheduling rule. Now, the same point is though, that would only be in the EDIM. They could presumably not do that in real time, but that would depend on what the balancing area rules are. And I'm going to talk about, rules that extend to this to real time in a second. But
Thank you.
There's a potential for this in the balancing area, and it all depends on how much, non-balancing area generation there is that impacts the constraints within the balancing areas. And the balancing areas should be worried about it if they've got a lot of generation located where it creates flows on their constraints. And they might have sold firm transmission thinking that, well, I can provide counterflow on the rare occasions when they need it. But if they make it possible for people to create money by doing these EDAM schedules, they might find their exposure is higher than they anticipated. Again, as Rick was saying, those unintended consequences. Now, as far as solutions, let me put that off and talk about that in a bit later, okay?
Good. Great. Okay, I think we have Dan Williams in queue.
Okay, Dan?
Scott, thanks. Dan Williams from the Energy Authority. I've been kind of listening all day, raising my hand, putting it back down, and I know we're already kind of over time here. But just the last point that you made about the fact that we have to keep in mind that there are not just vertically integrated balancing authorities in EDAM, that every one of them is more complicated than just the load, the generation owned by the same entity, and they're also running the balancing authority, and they're also the transmission provider. I know that we're trying to stay really focused here just on the CAISO policy and on the congestion allocation between the BAs, but I really hope at some point in the future that the MSC, maybe in combination with Dr. Pope and as the WEM governing body market expert, will get an opportunity to take a look at some of the implementation details for the EDAM balancing authorities, how the congestion is being split between entities, the incentives that are being created, how network transmission rights are being mapped within the EDAM BAs, and what that does or doesn't do for the market efficiency and kind of the end use consumer within these areas. I think we really have kind of done a disservice to the market by not focusing more in those areas because the EDAM BAs just aren't market operators. They don't have this experience. They're putting in an incredible amount of work in. They're doing a great job with their stakeholder processes, but we're kind of asking them to come up with ideas for how to run an efficient market within a BA, and that's just really not their kind of call of duty. So I hope that you all get to spend some time focusing on that at some point in the future.
Yeah, I understand your point, but I also understand that my knowledge of the details of the balancing areas is limited, and also the scope of, I'm not supposed to put in 200 hours a month on this, and they're limits, and we're way over what we're supposed to. So, but we tried, what we thought about, and the three of us talked about it, is those principles up front. We thought like putting those up front, people could talk about them in the context of what individual balancing areas do and say if they're good, but the CAISO could talk about to what extent they want to get us and Dr. Pope involved in the individual, but there are a lot of balancing areas and there's a lot of detail. So we're not exactly jumping off that cliff, at this point voluntarily.
That's one of the things to maybe look at in the future as we look into long-term solutions is just how NT resources, NT rights holders pay for use of the system, and then what these models are doing for allocating the rents back out to them. In the CRR model in general, like setting aside the auction and resale and stuff, the entities that are investing in it are getting a fixed amount of congestion revenue rights, and they're getting paid out regardless of how they actually use or schedule on those rights in the market. And within the framework that's being set up in EDAM, the long-term firm rights holders presumably are getting those because they have a generator, they have something that they're exporting to where they're wheeling through, and so they're more likely to have a pathway to use their max rights within the market and get their maximum hedge for those rights. NT customers, by definition, are paying based on a coincident peak, but are only going to get congestion revenues allocated to them if they, one, self-schedule, and two, if they somehow are using their rights 24/7 up to that coincident peak amount that they're actually paying for. And that's obviously not going to happen even if their resources were economically dispatched to the maximum at all times. It's just there's times of the year where it's infeasible for them to use the entire transmission portfolio they're paying for. So I think there's some serious asymmetry set up in the way that this is going to work in practice. And you know, it's something I hope if we don't get to it by market go live, that can be looked at as we're looking at long-term solutions.
Right. I mean, we're to talk about some solutions, but you know, getting into the allocation to coincident peak and so forth is exactly the type of morass I do not want to jump into. That's not my expertise. But
that's fair. It's a dark place no one wants to go to, but unfortunately there are
I know, but
tens of millions to hundreds of millions of dollars at stake here, and it would be a disservice to the end-use consumers not to get this right.
But I don't think that has to do with how they do that is not part of these principles. You know, I agree that that allocation should be done right, but let's go on and let's.
Okay. Well, let me just ask Dan a quick question. Are these NT parties that you're thinking of? Are these costs that are incurred and allocated within an individual BAA, and so it should be the BAA's responsibility, or are these often costs involved with longer distance transactions between BAAs and what NTs pay to get access to transmission rights between BAAs, and you're concerned with the equity in terms of what they get back? So within or between BAAs?
It's both, and I'd say that the closer that the BA that they live in is to a BA that is heavily constrained. So if you were, say, NV Energy as an EDAM BA sitting right next to the CAISO, and the more that you have resources and loads spread throughout the BA that you're an NT customer serving, I think the more likely it is that there will be a heavy amount of parallel flows impacting your your kind of bottom line at that point. And if the incentive is there to kind of be forced into self-scheduling, well, that just will unwind a large amount of the market benefits. And I think a number of us who have been commenting on this for months and years really want to see a program that incentivizes efficient participation in the market. And a lot of that gets down to having something that's more of a task-based allocation even to the NT customers, so that they're incentivized to just offer their generation economically, let the market dispatch it, and yet not have to bear too much of the cost of kind of other things happening in the market, causing them to have congestion risk.
Okay, thank you for the clarification. Okay, I think that's all we got queued up. Scott, you can go ahead. I'm looking forward to your to the solutions you're about.
A lot of problems. Let's see some solutions.
Right. Yeah. Okay. More problems. Go ahead to the next slide, please.
Oh, more problems. All right.
The other thing that, I think that we have to think about unintended consequences, as Rick was mentioned. You could have, to the extent you see prevailing flow congestion, you can also have phantom scheduling in the EDAM, overstated intermittent output. If it's got firm transmission rights or network service, and then it gets to realize the rebate value of the firm transmission rights. And, the adverse reliability impact of a lot of phantom schedules would be limited because we got rules about EDAM resource sufficiency, and maybe they can't do this. They'd get, that would be inconsistent with other rules, but the incentives are not good. So, that's the, now, since, and I was thinking about some rules. I don't drop that last point. I thought about it, I don't think it works. So that's a solution that doesn't work. But I'm worried about the phantom schedules and the reliability impacts. Go to the next slide. I'm going to try to pick it up here. Now, even if we don't actually have phantom scheduling, we're going to have uneconomic scheduling to receive congestion rebates. And that means that the EDM unit commitment is not going to be least cost. And we talked about that, we talked about how that would be the case, but then it doesn't necessarily unwind in real time. And that's the thing we got to realize is like in those examples, the efficient dispatch when the back down the high cost generation at A was you needed to have the generation at D. If the generation at D wasn't committed, or if it didn't buy gas, you can't do it. So this is, what Dan was talking about the efficiency gains from EDAM. And this self-scheduling isn't just incidental. Even if they just do it, they start doing it in the day-ahead market in order to get the congestion rents, it can spill over into less efficient outcomes in the day-ahead market. In the real-time market, because the day-ahead market schedules aren't right, people don't schedule gas, units aren't committed, and then you can't actually unwind it. You end up with inefficiency in real time. Go ahead to the next slide. Now you could say that this wouldn't be worse than the outcome under WEAM, because WEAMs have a similar incentive to include high cost resources and things that create flows. So some of this happens today. But then again, part of the EDAM benefits are doing it more efficiently than EDAM. So, we're not going to get those benefits if we have this if we have these bad incentives for self-scheduling in EDAM. And some of the constraints and the fact that WEAM is so close to real time, maybe there's actually less incentive to play these games because there isn't enough time to unwind them, so that people the schedules are what they are. Go to the next slide. I'm going to try to get through so we get done at a reasonable hour. Now, this is what James brought up earlier and a couple other people brought up. And, we can understand from conversations at the CAISO that they're considering a rule, the generation that's self-scheduled in EDAM has to be self-scheduled in real time. Now, it could work out that this undoes things and it reduces the benefits from the gaming self-scheduling, but it also could end up locking in the dispatch of the inefficient high-cost resources and actually increase the cost. It's hard to know. Maybe it would deter the phantom bid from the $35 unit, but it would cause you to actually run the $25 unit in the example. There's also, the history. You start doing this in real time, you're really asking for trouble. And this is what caused the Enron pricing scheme in PJM to unravel in the summer of 1997. It started incenting rampant self-scheduling and use of network service to self-schedule, and the PJM started to lose control of the system and had to take out-of-market actions, command and control to keep the lights on. And I've got some slides at the back in the appendix that are stuff I prepared 25 years ago or so, to talk about this when it was happening, and in 1999 in New England, in 2000 and 2001 in MISO, this did happen. There is a history. So we got to be really, I don't think we want to say, oh, we're going to force you to self-schedule in real time too, because that turns what's just a financial transfer into a real reliability risk where things could go really bad. So I'm strongly encourage the CAISO to not go down that path. Let me stop here and see if we've got some questions before I talk about some other options.
Yeah, now I want to clarify exactly what the DFP is proposing with regards to the real time. That James was talking about ETCs and TORs. Was that right? But not firm OAT rights?
No, so what James was asking was, under our current rules for balancing schedules for ETCs and TORs, we have a requirement that they have to carry that self-schedule through real time and even all the way through real time. That way I know that they are using their rights. I was asking, in essence, your opinion as to whether or not that same type of balancing requirement was necessary for OAT, because it's one of the areas of consideration we're looking at right now. So I heard Scott, and so I appreciate your response, Scott.
Yeah, and Jim and Ben, you might want to jump in to help CAISO get me with your views on this too.
Well, again, it's sort of like you can invent circumstances where it does act as a deterrence, but yeah, the downside of the like you got to live with it no matter what is it's a high risk scenario where and the other approach, there's some money that flows around, but you still end up using the right generation in the end. So
people respond to instructions in real time so that we don't end up with
yeah.
what PJM was. I mean, you can look at the back in the example, there was no generation on dispatch in Western PJM. An example in August 22, and I got the notes from the PJM website from the operators about why they, exercise command and control. And that's not good. That's really not good.
No, it feels like a game of chicken where neither car can turn aside at the last minute. I mean, if you lock things in, and it could be bad.
And that's fair. In the draft final proposal, we hadn't addressed that topic, which is why in our discussions previously and now I wanted to ask that question.
Right. Okay, now let's. I got 2 slides left, I think, and we can, or well, 3, but one will be really quick, so we can move through it and then we can take remaining comments. So go to the next slide. And this is just summarizing some of the issues we've talked about. I'm worried about use it or lose it. I'm worried about phantom generation. Those are the big concerns. Nick, go to the next slide. Now, what do we do? There are a couple approaches. We all know about CRR obligations. We do have to recognize that the WEC is getting different from 1999 and 2000 when we were allocating FTRs from nuclear plants, coal plants, and large-scale hydro to meet load because the power flow was always flowing. Now we're in a different world in the WEC. I think the CAISO should be looking at what are the congestion patterns so we can understand if obligation CRRs are even going to work much longer, or part of the low valuation is due to the fact they're not a very good hedge. And maybe we need to make changes, the times or whatever. The CAISO's got a lot to study. Maybe some of the market participants or consulting companies want to study that. How good is it? And then CRR options are another alternative, but they're very complicated to run the auctions for. If you're doing an AC power flow, it's almost fantasy. And even other approaches, it's very computationally difficult to and can reduce the amount of rights that are available. I want to talk a little bit about the third option, because it goes to what some of the people were talking about, and it's merciful. It's only one more slide. One more slide of torture. Now these, what I call financial flow entitlements, will be similar to the firm flow entitlements defined between PJM and MISO, but in this case, they'd be financial entitlements, so there'd be no use it or lose it incentives. You'd pay out the money regardless of whether who scheduled money. And they could be assigned to particular market participants, and that's why they can't be use it or lose it. When you have the PJM and MISO firm flow entitlements, the money doesn't go to any individual generator. It goes to MISO and PJM and goes into the overall market congestion rents. So it doesn't incent self-scheduling. But here, if we give it to an individual balancing area and it gets passed on to an individual generator, it would still create use it or lose it incentives. But what you could do is assign specific megawatt amounts of financial flow entitlements to BAAs, specific constraints, and the BAAs could reassign a specific megawatt amount to particular transmission customers based on their firm service, or they could aggregate it and assign it to a bunch of customers, NITS customers, some entitlement overall, and they get some amount. And this would be defined as a financial entitlement, a megawatt amount on a specific constraint. And you'd avoid the use it or lose it incentives, you cap the unpriced flows, and you could even, one effect is this: if it was a fixed megawatt amount, the entitlement wouldn't go up if there were outages that increased flows on the constraint. You'd only get that many megawatts. One thing about this design is that there's an outage, the shadow price of the constraint can go up a lot, and they get their full flow. They're hedged on their full firm transmission right flow and the constraint, even though the impact has increased a lot. And it could be, you could also reduce it in settlements if the transmission element was derated. So this is not as complicated as doing CRRs for everybody. It can be limited to a subset of constraints. That's what PJM and MISO do. They call it market-to-market constraints. Now they have 240, but we could start with something smaller for some of the balancing areas. So I think, before we plunge into other more elaborate future options that extend the self-scheduling incentive to even more resources, maybe we got to think about something like this, because it avoids a lot of the problems we've talked about. It puts a cap on how bad it could get. There's no phantom scheduling incentives. There's no use it or lose it incentives. It avoids self-scheduling because you just get the money. Now you have to cap it, but it's something for everybody to think about. So that's it. I've got some appendices with some, more numbers about showing how congestion rent settlements work and some horror story graphics about PJM in 1997, but this is it. So Ben and Jim, why don't you jump in, and then we'll take comments from anybody else that hasn't fallen asleep.
Yeah, I think all of us are wide awake at this point. We got some people queued up, but I'll go ahead and ask something and make a comment too. So handing to the BAA the responsibility to allocate entitlements, is that something they wouldn't want to touch with a 10-foot pole just because of the, it would be such a political thing. Who you going to give those to?
Well, I think they give it to the firm transmission. If the firm transmission rights holder has firm flows and it creates these, flows are the CAISO constraint or a BPA constraint or their constraint, they could choose to do it on their constraints too. And then it addresses some of those concerns of, no use it or lose it incentives. Nobody can gobble it all up with, phantom schedules, and you could put it in a pot. Some people that have specific point-to-point rights, you could give them so much. Some people that have a bunch of resources and a bunch of loads, you could give, some sort of aggregate entitlement. But yeah, you have to allocate the money, but, that's what regulation is about. And in the end, the regulators and FERC and, all of them are going to have to, make decisions. Doing it randomly isn't, as someone was saying, the outcomes from this could be kind of random and induce a whole lot of inefficient behavior. I think it was Dan Williams, but I'm losing track of.
Yeah, I mean, the way I think about this is from a revenue adequacy kind of paradigm. It's just, and so if you're giving them some more funds, that makes it easier for them to provide a complete hedge and not go inadequate.
Right. And you can tell the firm transmission customer, we're not promising you the moon. We're not going to make you whole for, weird stuff you do to inflate your flows, but, here's a reasonable entitlement for your congestion impacts.
The other thing I just wanted to mention is it's wonderful to see CR options made mentioned again, because I've always been surprised that those haven't been more popular than they've become, which is not at all popular. And I do understand that in an AC load flow, that's just not possible at all. But I thought that in LP, it was just, emitting some coefficients from the constraint set. We don't have to get in the mathematics, but just a quick question. When are AC load flow models important for allocating transmission rights? I thought all the models were basically DC, linearized DC, linear program sort of a thing.
Nexent and NICE, uses an AC model. NISO uses it, CAISO uses it. And even if it's an LP program, the revenue adequacy theorem we proved, 28 years ago, is you have to test whether all the options are simultaneously feasible for all possible combinations of the exercise of those options. Now the vendors have got some shortcuts, but I mean, that's a horrific, absolutely horrific revenue adequacy. And the vendors are, incredibly smart, and they get things that are reasonable approximations, but it's still bad computational. That's why PJM says we're only going to let you PJM and ERCOT have options and people buy them, but they got to limit it to keep themselves from, spending $200 million on computers to solve a $50 million.
Well,
Right,
and we
right.
can't even keep regular CRRs revenue adequate. So
Yeah.
Yeah, but I'm thinking back to literature 20 years ago, and I know I haven't kept up with that, but it's just an LP, and it was no worse than pure obligations. But
No, that's not the way that's not, I mean, you can look at some other Hogan papers, but there's a paper, it's on I got it on a website, it's on Hogan's website, and I'm not aware of anybody that's proven anything different. So
yeah, I'm thinking of some O'Neill stuff. But anyway, this is ancient history. It's like talking about Virgil and Homer. So anyway, so Jim?
I mean, I guess I already injected my a couple thoughts. I mean, one other thing that I brought up that I think may be so out of left field that I don't know how it fits because I don't understand oats, but it was this idea of if we want to provide the ability to schedule day to day without paying any congestion, that is possible. It's all a matter of money. Right. And even if the congestion costs aren't being directly sent back to the BAA, ultimately it might be considered part of the cost of, running a grid. And if OAT rates are adjustable year by year, which is my understanding is in theory they could be, and they are cost based, then part of the cost could be the cost of covering the the congestion that's associated with parallel flows as well. That would just be baked into the sale price of an OAT right for the following year, in a sense of sort of a year by year cost recovery kind of approach. That would be taking it away from the underlying capital cost foundation, but it would be another way of trying to provide people with a firm hedge, but not have the BAA have to go into negative revenue territory to provide it.
Well, wouldn't the BAA have to go into negative territory? Because if it was the Martin Luther King weekend, the shortfall would dwarf, what the.
Well, yeah, my thing is there'd be revenue smoothing. So the extent that they go short in one year gets baked into the cost of selling the rights the following year.
Yeah, well, that might produce a death spiral, wouldn't it?
It could, yeah.
Yeah.
I mean, it depends how big we're talking, I guess.
Operator, is there anybody on the line?
Yes, we do have two hands raised. We'll go to the first one. Kathleen. Kathleen, go ahead.
Great, thanks. Kathleen Colbert from Vistra. Can you hear me?
Yep.
Excellent. And no, did not fall asleep. Been riveted. And very and a little scared, to be honest. But can I ask a question as we go back to slide 30?
3?
Because I want to 30, please. I want to understand what you're putting out here, because I'm most of the way there, Scott, but I think I'm missing something. So let me ask you this question. So I have been considering this what I'll just call like the war on self-schedules as a lost war with the EDAM order. And the reason for that is because the exercising of the OAT rights in the market section of the EDAM filing and the EDAM approval all stipulated to preserve your OAT rights, you have to submit a self-schedule. Now, I've been curiously reading this section over as you've been talking, and perhaps there's something that was just missing in the clarity, and it's a discussion that you've had with the staff. So I want to try to get this clarity for us on the stakeholder side. But the way I had understood it is you have to submit the self-schedule in day ahead. If you didn't, then you get an opportunity to submit the intraday self-schedule to exercise your rights. But I don't remember anything about you submit a self-schedule in day ahead, but then you would not have a self-schedule in real time. And so I wanted to ask you, this is my question. I guess I had presumed, based on how CAISO's filing and the order and all the discussions had worked, in the stakeholder process is that it was kind of presumed, not a new rule, but I understood the rule to be if you self-schedule in day ahead, you're exercising those rights, and then you maintain that self-schedule through real time. But your discussion questioned my understanding and recollection. So my question is, are you saying that you've heard from CAISO that that's not the case, and you could have?
Well, that was the dialogue I was having with James Lynn, and you know, he said that CAISO is considering having that requirement, but it isn't formally part of the proposal at this point. I've had some discussions that indicated, no, it isn't a requirement at this point, and I think that's a very good idea. I think, you know, you're getting into very dangerous ground if you start to require, you know, these incentives to self-schedule, especially if it's, you know, most of the time these parallel flows congestion won't be very material, but suppose it's one of those times like the Martin Luther King weekend where these are big numbers, and then people start self-scheduling, and it's already a bad situation, and you force them to self-schedule not only in the day ahead market, but in real time, in their in potentially network service as opposed to various firm rights. And you know, it's
I think that
scheduling you got, you know, the worse it is. I'm not saying what the tariff is going to be and what everybody's saying. I'm just saying this is a really bad idea. There's a really dangerous idea to make people self-schedule in real time. That's the whole reason we can just, you know, financial transmission rights, because we saw bad things happening in the old world.
I support you. It is my understanding that it is the rule, though.
Well, that's
And so
fine.
that's
If it is, then, you know, my comments about what's not a good idea apply. But James,
yeah, no, 100%.
that it isn't.
I'm just wondering if you can clarify.
So,
Yeah, thanks.
if I can jump in. So if you want to self-schedule your OAT rights under the current EDAM proposal, if you want to self-schedule your OAT rights, and in order to get the scheduling priority and retain that scheduling priority in real time, then yes, you would self-schedule both day ahead and real time. If you came into real time and did not self-schedule but economically bid, you are saying that you're willing to give up your scheduling priority in order for an economic dispatch. If you don't submit anything, the market will automatically put a self-schedule in for you.
That's consistent with my understanding. I feel like there might be a piece from the TSP side where if you exercise, because there's some coordination with the TSP as well on the priority for those intraday self-schedules. And under OAT world, if you exercise it in day ahead, I'm not sure you can just decide to relinquish it back. But I would appreciate greater clarity on this, because I think Scott is raising a really good point. And if the CAISO could confirm that, whether that's actually practical, I guess. So like the way that I had understood it would work is if you exercise it in day ahead, the transmission service provider sees, okay, you've exercised your day ahead, and then you would have to, at least per the TSP side of this equation, maintain it into real time. So I appreciate, James, you're saying that CAISO's rules might let you change that, but I'm not sure that TSP would, and if we get a little bit more education on that, that would be great. But I really
remember that this is also network service as firm service. So you could self-schedule your network service in day ahead and then let it be on dispatch in real time. It isn't only point-to-point schedules between balancing areas.
I recognize, I mean, when CAISO went forward and adopted this, made this policy decision to only allow the OAT rights to be preserved through self-schedules, many stakeholders raised concerns, and I just really appreciate you explaining why.
So one of the things we have to make a distinction on, Kathy, is the discussion on transfer system resources, self-schedule, versus internal use of your OAT rights. If you self-schedule a transfer system resource on the day ahead, yes, it is expected to be retained into real time, and the entity would have to make adjustments if it was required, because you've committed that transfer between the BAAs. If you are going from a generator to an internal load, that is not necessarily a requirement. It's the transfer system resource that has to be retained in real time. Now, it doesn't, that's because you're exercising your right to get across the BAAs.
Mm-hmm. No, I really appreciate the clarification. Don't need to take up too much time. I had been thinking about this effort, the congestion EDAM or the EDAM congestion revenue allocation, as already accepting the self-schedules of the new law of the land, and really only been thinking about how we're allocating the congestion between the BAAs. But it's a, like I said, a riveting conversation thing.
Right, so we do have one last hand raised from Abram. Go ahead.
Hi, Scott. So terrific presentation and slides. I'm wondering, obviously, the what you have on slide 37 is financial flow entitlements would potentially solve the issue of equal treatment of California loads, firm or FERB equivalent rights being able to be made, treated equivalently from non-Cal ISO OAT rights. I'm curious about whether you think, you discussed that there might be some initiatives that should happen among the BAAs thinking sooner than, even before go live about addressing this. And this does seem to be one where BAAs could get together and look at the WEAM constraints and the, the physical firm rights that exist on different BAA systems, or what OAT rights are out there, and see if there's some rough business solution among the BAAs about how you would allocate flow entitlement rights in a way that everybody could agree to and would, as much as possible, preserve, as you say, the benefit of the bargain here. It seems like it's a to leave that till after go live, if there are lots of these, really bad incentives, as you say. I don't want to say gaming or anything like that, but people are just going to follow the market. It seems to me like it would make sense for Cal ISO and the neighboring BAAs to think about this potential solution, because it has worked in other regions.
Yeah, Abram, I think it's something, I think it could be applied BAA by BAA, Pacific Corp and CAISO could agree on these entitlements between them, and CAISO and Pacific Corp and Portland General could agree, and, we wouldn't have to get everybody in the room at once, because some people might not want to be in the room, but those that join EDAM, they could work out this kind of agreement. And you could also look at what their, historical base schedule flows were. And yeah, Abram, I'm glad you brought that up, because when you were talking, I meant to come back and say this would solve the CAISO problem, but I forgot. But yeah, you're exactly right, that you could make it symmetric between the CAISO and other BAs without having self-scheduling, to just have, similar firm entitlements. But I don't even know if it matters. I don't know if there are any binding constraints that transactions from Edison to PG&E actually create, but there might be.
Can you imagine doing this before going live, as Abram suggests, Scott?
Well, I'm not the one who have to do it, so I shouldn't do the imagining. We should leave that to CAISO and the affected balancing areas to think about whether, and but obviously what market participants think of it is relevant to as well.
Okay. I think we've gotten through, we're through the queue. I don't have further questions or comments, except to say that we were on schedule to provide feedback to the board, our formal opinion or a board memo to the board, probably to be adopted on May 19th, on Monday, directly before the board meeting, and a week after the final proposal is released. We're all, of course, looking forward to the comments that are submitted on Monday. That's, those will be definitely very helpful to us to make sure we focus on the right issues. Let me check, Jim, Scott, anything else you want to say about?
Not me.
This, a tremendous amount of work went into the slides that staff and you all prepared, and really appreciate that effort. And I'm sure the stakeholders do. We still got 60 of them here or so. Okay, so if there's nothing further, there will be the meeting on the that's will be scheduled for the 19th, will be posted. Look forward to seeing you then. I don't believe there are any stakeholder meetings next week on this, if I'm correct, James, or anybody else. Amelia?
That's correct.
There is no, that is correct, yeah.
Okay, well, look forward to the comments in the final proposal, and then to discussing this when if we adopt opinion, and when this goes before the board. Thanks, everybody. I wish you a good weekend.
Take care all.
Take care. Bye.
You too. Thank you so much.
That concludes our conference. You may now disconnect.